And before we start the stakeholder session, let me introduce myself. My name is Simon Gitonga. I am the convener of the Institute's Knowledge Development Committee, and I'll be the one to start you off with a word of prayer. But before I even start with a word of prayer, let us reflect back and look at a verse in the Bible. That is Matthew 25, verse 25, Matthew 25, verse 14, which talks about the parable that Jesus gave, whereby a rich man was leaving his house and he happened to go to a distant land somewhere. But before he left his servants with some talents. He gave them some money or some responsibility, and he wanted to see how they would grow those talents. And like the parable, we as the captains of industry, we as the leadership team of the insurance industry today need to grow our talents so that later on in life, when those who come after us come and ask, to what extent did you grow the talents, we'll be able to show the good work of our hands. So without much further ado, let us start off with a word of prayer before I introduce the director of the Institute. Our Heavenly Father, we thank you this morning. We thank you for giving us life. We thank you for an opportunity to give us a chance to have these deliberations. Assist us and help us in all the discussions that we will have, that they will be for the benefit of this industry. Grow this industry, help us to be able to see the opportunities available so that we may grow this pie. The collective wisdom seated in this room, seated in this webinar, seated in this seminar or session can be able to grow this industry to greater heights. Let the deliberations that will be made during these discussions be for the benefit of the industry so that later on we might be able to see a bigger industry than what is currently there. We ask these prayers, believing and trusting in Jesus' name we pray. Amen. Amen. Allow me to welcome Madam Agnes Masharia, the Director of the Insurance Institute of Kenya.
Thank you very much, Simon, our knowledge and development convener, for starting us with a word of prayer and even a verse. Thank you very much. Good morning all and welcome. I'm delighted to welcome you all to this unprecedented stakeholders and insurance executive workshop. It has been said that if you want to walk quickly, walk alone. But if you want to walk far, walk with others. And this is why we partnered with the Insurance Regulatory Authority and collaborated with IIB and CII London while incorporating our longtime partners, KPMG, in order to deliver effectively to you delegates today. May I take this early opportunity to welcome and recognize and appreciate them for working with us, the Insurance Institute of Kenya, not forgetting to distinguish our moderator for the day, Mr. Robert Koloba, Chief Manager, Policy, Research and Development at IRA. I'm delighted to recognize high-level representation by IRA, IIK, and College of Insurance in this forum. Allow me at this juncture to recognize and appreciate the CEOs, COOs, GMDs, MDs, and GMs represented here from the insurance and reinsurance companies, insurance brokers, and reinsurance brokers, as well as bank assurance operators. For IIK, this workshop is a strong message about its deliberate intention of remaining significant and delivering value to its stakeholders and insurance professionals, starting with you delegates, the leaders of this market, the leaders and decision makers in this insurance market. But more than that, IIK is sending a strong message of inspiration to the insurance players to deliberately look for opportunities like this, to team up in order to come up with appropriate solutions and transformational programs in order to broaden the pie and retain it for growth and profitability, as well articulated in the workshop's theme today. I feel obliged to thank the insurance players who have continued to support the insurance staff to pursue their insurance studies in order to become insurance professionals. It is comforting to note that a good number of stakeholders and insurance players also pay IIK membership subscription for their professionals. And for this, IIK applauds them, without forgetting and requesting those companies that do not support their professionals to engage in continuous professional development to consider doing so going forward in order for their staff to be well equipped to broaden the pie and retain it. Let me make one more request. Delegates, I'm sure you are aware that the insurance professional bill is in Parliament, having passed the first reading on 10th September 2020. The bill will help in streamlining the industry by creating an insurance disciplinary committee that will deal with errant members while enhancing insurance professionalism, which will create quality service to public, trustworthiness, transparency, responsibility, and accountability of insurance professionals. All this will enhance public trust, which is necessary for the purpose of broadening the pie. We are in the process of preparing to conduct stakeholders engagements, and we count on your support as insurance professionals. I'm also inviting you to this year's virtual conference to be held on 5th and 6th November 2020, morning sections only. The theme of this year's conference is Resilience and Thriving Amidst COVID-19. Can the insurance industry navigate optimally? We will be having excellent international and local speakers. And since we have leaders of insurance market today here, may I let you know that we'll be having a paper on leadership during crisis, embracing corporate governance. And our speaker will be Peter Crow, an expert in corporate governance and board effectiveness. You cannot afford to miss these leaders. Finally, on behalf of the Executive Council of the Insurance Institute of Kenya, I'm humbled to take this opportunity to invite our chief guest to open this virtual workshop, without forgetting to appreciate him for working with IIK. Can I say, come rain, come shine. He has always supported IIK, and for that, we appreciate him. Our chief guest is our very own Commissioner and CEO of Insurance Regulatory Authority, Kenya, Mr. Godfrey Kiptum. Welcome, Commissioner. Thank you very much.
We can't hear him, he's muted.
Insurance professionals that have attended this conference, distinguished guests, ladies and gentlemen, good morning.
Good morning.
Morning.
Good morning.
Allow me to thank the director of the Institute for inviting me to this conference, and more importantly, on the selection of the theme for the conference, which is broadening the pie and preserving it for growth and profitability. Of course, this would not have come at a more opportune time that our sector is facing a lot of challenges. You all know, of course, that we have gone through this year since March, and the effects of this is still going to be with us for quite a long time. And it is projected that the challenges of this pandemic will continue to impact on our economy, notwithstanding, and also the insurance sector that will be greatly impacted, both on the balance sheets and also on the risks that it undertakes. As you very well know, the pie we are talking about is the insurance sector, and in 2018, we had premiums of close to 216 billion. In 2019, it is projected to be close to about 230 billion. But what do we need to do to grow this and get the pie to reach everyone, or to reach as many people as possible, and also to provide protection to policyholders and the people of the Republic of Kenya. And it behoves the insurance professionals and persons who are managing insurance companies to ensure that this pie grows, the objectives are achieved. And of course, for the number of years that you know, it has been a challenge to grow this. We have had growth in less than 3%. We have penetration of about 2.3%. And you may remember that sometimes back in 2015, I'm not too sure when it was, we issued new product guidelines with standard policy wordings to make it easier for consumers of insurance products to understand what they are buying, and to also understand when they need to lodge a claim, and to understand when some of those claims are excluded from their contracts. I do remember at the beginning of this year, we had a very big debate on COVID-19. And there were discussions that being a pandemic, it is excluded. And of course, in a very academic sense, yes, it is excluded. But is it in your contracts? You as professionals who develop those insurance contracts, did you take that into account? Or we just took it from our books and said it is not covered, therefore you didn't need to provide for it? And when the rubber met the road, then that's when we realized that there were gaps in our policy wordings. Of course, from where we sit, we expect that those will be improved in the coming days, and I'm sure that the professionals in this room will take care of that. The other factor that I want to discuss about is on issues of affordability. How do we price our products? Is it fair, competitive, or just meant to be the cheapest from the nearest competitor? And do those prices cover the risk? Or they are just issued, and once a claim arises, and because the pricing was extremely poor, your policyholders clutching on pieces of paper, and you cannot be able to pay them because you don't have enough premiums and money to pay. Or do you say, after all, we'll go back to the owners of capital, the shareholders, to inject money so that you can pay those claims? Or you run to quickly decline the payment of those claims that have materialized because you did price properly and you didn't take into account all the risk circumstances. Following on that also, we need as professionals to make sure that insurance is not treated as a luxury item that is bought last when you have met all the basic necessities. But we need to bring this to the fore of our planning so that insurance as a risk protection mechanism is taken into great consideration as you plan on your expenditures. Of course, we do know and do understand that currently our market is facing extremely unhealthy competition based on the similarity of products and that the products are all the same. There's no product differentiation. We all sell the same product. If it is motor third party, if it is medical, we sell these products, put in all the exclusions that you think you want to put in, and they are all the same. The exclusions are the same to a large extent. Does this serve us properly, or it just serves for us to have a product to sell that is not meant to offer any protection to anyone? In the long run, professionals must be challenged to make sure that the needs of the class who buy insurance is protected. Now allow me to take on the third item, which is quality. And in this context, it means what time do we take to pay those claims that have materialized? What kind of financial education and consumer education do we give to our clients? Do they understand what we are selling, or we just sell to get the money and disappear in the nearest corner as soon as you have received the money, put it in your pocket or put it in your accounts for those who do so, and then that is the end of it. Once a claim arises, you tell them to look at clause so and so, clause so and so, clause so and so, which excludes everything that you sold. And therefore, that customer has nothing to hold apart from the piece of paper that was given. And what is our role as professionals in ensuring that what we sell is what we mean and that it addresses the needs of humanity and that we pay those claims as soon as they arise, so long as they are eligible for payment, depending on how you had sold it. Now, I think the next question that I want us to address is how do we grow that pie? How do we increase the number of policyholders? How do we bring in more people to the insurance sector? We currently have a number of policies that are estimated at about 3.9 million policies. And we have a population of about 50 million. I know a number of those people who are past 65, 70 are automatically excluded from your products in most cases. Then the people under 18 cannot enter into any insurance contract because they are under 18. They can only be under the wings of someone. And of course, you also know that our population is bulging at the bottom. So how do we bring in then the people who are between past 18 and below 65 into this bracket in large numbers? I think that is a question that the Institute can tackle going forward. The other thing is also that we need to quicken the turnaround times for policy approvals. I do remember there was a complainant who bought a policy, and Monica, who is here, will attest to this. This complainant bought a policy in Kakamega through ASACO. And the policy, according to him, was approved because there's nobody who got back to him to say that it had been declined. She only learned that the policy had been declined when she had a claim 9-10 months down the road. But nobody bothered in between to communicate to that person that your policy is not was not covered. And the premium was taken and collected, and she was issued with a receipt. But of course, at the time of claiming, now she learns that there's nothing for her to claim, and there's also no refund for the premium. So you can imagine how their opinion on you as insurance professionals. And I leave it to you to guess where you are in their radar. Are you at the top or are you at the bottom in terms of trust and believability? The other thing, of course, that we need to think about is on the delivery channels of our products. We rely on the same channels that we have always done so from time immemorial. We rely on our brokers as usual, faithful and selling all over the place with the insurance agents. But how many of us have adopted technology to improve on this? How many of us has taken the honors on training and educating their consumers on insurance products? I bet that if we were to do statistics and data, we will find that there are very few. I know IIK has tried a little bit. IRA has put in an effort. And I've seen 1 or 2 companies try to do so, but the majority of us are folding up our arms and waiting for someone to do something new, then we all just rush in and copy and sell it at a lesser price than even what had been expected. Of course, the other item that we had said we were going to talk about is an issue of affordability and how we can make insurance products more flexible in terms of paying premiums and enhancing premium transparency and pricing. Do we allow our consumers flexibility to pay their premiums as and when they get their money, apart from the life business, which they can pay on a monthly basis? The rest of the products, you are told to pay cash, or you are given credit that is indefinite, and nobody will bother to ask you to pay. And at the end of the year, you give us a report that you are owed by so-and-so, that is debt that is 3 years old. And all this is being done by insurance professionals and of course the accountants who assist you. And we must ask ourselves, then what are we doing? Are we selling insurance or we are selling credit policies? Possibly we should turn ourselves into banks so that we can give credit and collect interest. Then I want to turn into the role of professionals. What is your role as a professional in the insurance sector? You need to critically examine your role in product development. You need to critically examine your role in meeting those customer requirements. You need to critically examine your role in creating awareness, in pricing, and needless to mention, the quality of the products that you sell. And I want to just report to you briefly on what IIK has done over the past years in terms of pricing. No, not pricing actually, in terms of promoting the development of the insurance sector. You know, one of our key mandates is to promote the development of the insurance sector. And you will be in the know that the authority has developed microinsurance regulations that are currently pending before Parliament. And that will simplify insurance products. It will also ease access and improve on affordability. These will be cheap products that will be available to many more people than is currently possible with the current generic and generic insurance products that we have. The authority has also created awareness, and you all know that we have gone to all corners of the country. We will still continue doing so. We have also trained professionals and COP persons to sell insurance in the whole country. We are currently, of course, engaged in a project of building actuarial capacity for the last about 7 years. And this, the authority and the board is committed to continue doing so until we have enough capacity to be able to price our products properly and advise us on how to run our companies. The authority has also, as I earlier mentioned, issued simplified policy wordings for quite a number of insurance products. We have also issued model insurance agency contracts that persons who are supposed to adopt and use it in their in developing their agency contracts. And I want to now go into the most the newest thing that is in the market, and that is the IIK bill that is currently, as mentioned by the director, currently in Parliament. And we expect that this bill will give IIK the mandate to promote professionalism, continue to build professional development in the sector, and ensure that people adhere to a code of conduct that has been agreed and adopted by yourselves. And that will make sure that we all operate on the straight and narrow in the coming days. And finally, I want to congratulate the IIK for inviting a speaker from London, the CII, who will give us an example of how insurance has been done there. As you very well know, currently the UK is the fourth biggest insurance market in the world. And you mostly know that most of our policies are also placed in London on the next level. The whatever cannot be consumed here is placed in the London market for most insurance companies. So without further ado, I want to thank you and wish you a good morning. Thank you very much and all the best.
Thank you very much, our commissioner. We really appreciate the way you have challenged us, professionals, and we are ready to go now. We want to thank you, and I'll take this opportunity to ask Alice Njoroge, the Deputy Director of the Insurance Institute of Kenya, to give us an overview of today's workshop. Karibu, Alice.
Thank you, Director. Good morning, everyone. Our Commissioner of Insurance, the Director of IIK, and my fellow directors in the IRA. We have Director Douglas Kairanya with us here. We have Director Cheboy, we have Director Joyce, and even our chairman is also logged in. Good morning, everyone. And I also wish to acknowledge the presence of the Executive Council of the IIK, together with all the CEOs present in this presentation. Good morning, everyone. Like I've been introduced, my name is Alice Njoroge. I'm the Deputy Director of IIK. It's my duty today to give an overview of today's program. One writer, Winston Churchill, said that men occasionally stumble over the truth, but most of them pick themselves up and hurry as nothing has happened. There's nothing that describes us best as the insurers as that quote. We often stumble on the truth. We often hold conferences on the truth about the industry penetration, about how we are handling our businesses as professionals, but we just pick pick up those truths and hurry up as nothing has happened. The IIK, in its thinking, found it fit for us to have a conference, for us to have a serious discussion on the PI. The PI is the insurance that we handle on a day-to-day basis. A PI is delicious, and you're wrong to find a moment to enjoy it. Is it time for us as insurers to think through that it is time to enjoy what we do, it is time to take seriously what we do, and is it time to take our industry to the next level? It is my prayer that after today's conference, we shall pick this pie individually, we shall embrace the practices as the commissioner has told us this morning. We will take the lessons that we ran from this conference, and we will be all proud professionals to grow this pie and think of ways and means of how we can sustain this pie. It is my humble duty, therefore, this morning to introduce to you the speakers for the day. Our first paper will be on insights of the insurance gaps, building blocks to local solutions, and the transformational agenda. Who else can be able to give us a presentation than the IIB team? The IIB is the Insurance Institute Bureau, Information Bureau, which has a founder from Isaac Ngaro. We all know Isaac Ngaro as a writer of insurance matters in this industry. He is the founder of that Information Bureau, and he'll be telling us of the things, of many issues that they have come across in the industry. With Isaac will also be Oyare, who is the strategy manager in Moirore. They will each give us a presentation on 5 minutes. The second presentation will be brought by Lawrence Smith. Welcome, Lawrence. We can see you logged in all the way from the UK. Lawrence Smith is the ACII Regional Director in Africa, and he is an editor of the CII publications. He has written so many publications that I would urge all of you to log in and see those publications. I hope, Lawrence, you'll be sharing with us the link so that we can get to learn more about the insurance matters. And Lawrence has a wide knowledge on regional and international insurance markets, and he has a lot of benchmarks on the key matrices of the gaps that we require to fill in the insurance industry. The third presenter will be from KPMG. KPMG partners with IIK. We collaborate with them on insurance matters. And our presenter will be Alex Bai, and he will be bringing, Alex is a certified public accountant, and he'll be bringing to us the gaps and solutions in the insurance industry. Then we will end the day with Lawrence again coming on board to tell us the key issues facing CEOs. So my CEOs, please, I urge you to stay on board, and so that you can hear what Lawrence has going to take us from here, so that he can now have the first speakers kick us up. That is the IIB team. And therefore, I take this opportunity to welcome Robert Uroba. Thank you.
Thank you. Thank you, Director Alice, and welcome all of you to this conference, this workshop. I think we go straight into the presentations, but shortly before I invite the speakers to give their presentations, just a bit of housekeeping rules. I request that we give the speakers time to make their presentations up to the end. Then we get time to interact with them. But you feel free to forward your comments through the chat wall. And I also request the speakers to be keen on the chat wall to see what comments are being raised, so that you could instantly provide feedback to our delegates on the issues that they are raising, but also take an opportunity at the end of the presentation to quickly run through the feedback that we're getting from our delegates. So without much ado, I want to invite the first speaker. That's IEB. Isaac, I don't know how you've arranged yourself to do the presentation. Can I ask George to start us off? Let me invite George Miruri to take us off. The presenter, you have 20 minutes and I will be timing the presentations. So please try to keep within your 20 minutes of the presentation that has been allocated on the program. So George, welcome to take us through your presentation on insights and insurance gaps, building blocks to local solutions and the transformation agenda for work that has been done by IIB. George? Or Isaac, you're going first? Isaac, you might unmute.
It's George.
Isaac, you can go if George is.
Hello?
Yes,
Robert, thank you very much. Are you hearing me now?
Yes.
I've been unmuted. Thank you very much, and thank you for clarifying the rules of engagement because of time management. And I take this opportunity to welcome everybody and say good morning to all our participants. Yeah, we have arranged to make the presentation with IIB team, Isaac Ngaro and Richard Oyare. We have about 12 slides, and 12 slides within 20 minutes, within a time span of 20 minutes to talk about our building blocks. I'm not sure whether the host has put the presentation for the participants to see. I have it on my screen. We envisage that the presentation will be put on the screen by the host. First slide, it's been put there. You see the pie, how small or big it is, and you've talked about the pie being small.
If you can't see your presentation, I request you share the screen.
All right, we had requested the host to share, or Richard Oyare, are you able to share the screen with the participants? Richard Oyare, are you able to share the screen with the participants? We had requested the host to share that.
Or Mercy, if you're able to do that, please do. Or
Richard? Richard Oyare, are you? Oh yeah, there it is. Yeah, we are good to see. Yeah, much has been talked about the pie and how big or small it is, and we all agree it is very small, as you see from that screen. From 2018, it was about 2.43, and we just heard from our IRA CEO, it's about 2.3 in the last year. And we all agree that that's not the best position that we should be having. And from our IB work, we envisage that we can really grow the pie to 3.5 to 4% and to 5%. 5% not being optimal, but is the first indication that the pie can keep growing so that everybody can have a piece of the pie, and you know what that means. On slide 2, we'll be able to see the few introductory remarks that we've put there about the insurance penetration ratio and what it means versus our GDP. Richard Oyare, are you moving the slides together with me? You're seeing the first slide, you're not seeing the second one? Yes, those are just introductory remarks in slide 2, and we'll not go much into detail to that. They are self-explanatory because of our time management. But I would want to invite and pay a little bit attention with a few minutes on slide number 3. That is the graph that you've collected from the last 14 years. Slide 3, Richard Oyare from IIK. And you've seen a trend, in my own words, for lack of better words, I would say worrying trend, from the last 14 years, starting with 2006 to 2018. From 2006, we had an upward trajectory and growth of insurance. It was affected a little bit in post-election violence of 2007-2008, but it progressed to the peak in 2013, the highest ever of 3.45%. we had what we'd call a little bit of a plateau, a small plateau 2013-14, and we'll see that in the next slide. But more worrying is from 2014-15 to 2018, our penetration ratio has been on a rolling stone going downwards. And when you look at those factors in relation to our GDP and our population, it illustrates the insurance needs are growing, but the ratio and the consumption of the product is going down. That has been a worrying trend because even 2019 is projected to go down. And I'm not sure even 2020, it will be better with COVID-19. Our analyst in the next slide, Richard Oyare, will show us what happened in those years, because it's not just data. And the 2006 to 2012, the upward trajectory, we were able to decipher that 3 factors contributed to the growth. The first one is our economic growth that hit a peak of about 6.1%. And without going to details, you can see the industry, what was happening in our economy and availability of cash. Followed to that was subsequent legislations that created optimism and drove us to drive insurance. And we can read that in more detail because of time. But one and most important is the enactment of the Insurance Amendment Act that created IRA. And as we heard from our CEO, there have been concerted efforts and vigorous, very good efforts that have driven insurance penetration. But down there, we'll see us as the players. The industry itself was able to significantly invest in management of the institutions or their organizations, in skills development, distribution channels, internal processes, and human resources. And though it dropped a bit in 2008 because of post-election violence, we can see a trajectory. 2013-14 is a small peak, which we researched and tried to understand what happened during that period. And we see there was a government requirement, all the civil servants and discipline forces were insured, that increased the premiums. In 2014, there were more premiums than 2013, but the drop was in the ratio was as a result of the debasing of the GDP that took it to 2.9%. And subsequent to that, there was a political risk insurance because of 2013, what people had learned in 2008, and there was a surge in insurance purchases. Unfortunately, 2015, 2019, we started rolling down. We looked at the circumstances that led to that. The terrain started changing, and the emerging markets in the areas of microinsurance, the Generation Y young guys, infrastructure, agriculture, all in sub-Saharan Africa, South Africa, and in India, Taiwan, and Korea. And this represented and represents 86% of the world population with a GDP of 40%. So what did we do as the players to understand and to align ourselves with the emerging markets? The data showed, to our dismay, we did not do much to understand and to penetrate when we have 86% of the population in that market. We did not have innovation, get the systems, get the products, develop our people and align them with the emerging markets. So the terrain shifted despite our very progressive performance in the previous years. Unhealthy competition crept in, and that affects and continues to affect us even to date. And then for lack of understanding the customer who has come out in the emerging markets, our customer service went down. And even in our survey that was done last year, over 71% of the respondents decried lack of customer service in the industry for the services they get. Let's go to the next slide, Richard. From our 2019 insurance survey, which we participated, most of you participated, we saw the factors that came out and how the respondents tagged them and rated them. And the same story in the emerging markets. Did we have innovation? What were the channels? What were the awareness, which I felt I had our CEO of the IRA talking about? What is the level of customer service? The low-income earners in the markets, the youth. what are the level of the standards of the professional players in the industry, and how do we perceive that industry? And we still talked hard about pricing and flexibility of our insurance products and our payments plans. Those are the outcomes that we got from last year's survey that are comparable with what happened in the 2015 to 2019. Next slide, Richard. We looked at, the next slide is about benchmarking. Where are we in relation to the best practices in the world? And up there you can see the emerging markets of Taiwan and Hong Kong and Southern Africa. And we'll see a little bit in the next slide what happened. You'll see worryingly where we are at the tail end of that continent. Our highest ranking country is Southern Africa. Their agriculture insurance, which is part of the emerging markets, has been greatly and largely developed, which contributes to over 77% of their income and their employment, contributing largely to their insurance development. So it's good to look at ourselves with the best and the worst. And the next slide will show us what these success stories, what they have done well, because it's not just about getting it right. The first thing is their professional standards and development, their acquisition and development of management of their insurance professionals and the arena is at a higher level. Their public awareness of insurance and acceptance, it's a higher level. Their use of data from the emerging markets to understand what the customer needs are, their profile and how to service them, their products and their distribution. Digital era, we cannot deny that we're in digital era, but how have we applied it to the betterment and to progression of insurance? They have done that better. Change management and adherence to strict business professional ethics, which my colleagues will be talking about. And then continued research and benchmarking so that we can continuously see what others are doing and how they can do better. So the next two slides, my colleague Richard Oyare will take us through now, having seen where we are, where the world is, the circumstances, what do we need to do better to broaden this pie? Richard Oyare.
Good morning.
Richard.
Thank you, Robert. Good morning, all the participants.
Richard, can you hear me?
I can hear you, Robert.
Yeah, Charles has taken 11 minutes, so you have 9 together with
Isaac.
Thank you.
Welcome.
So we are talking about building blocks to local solutions and the transformation agenda. And a lot of this that we talk about are based on the research that we carried out in 2019 and in the first quarter of 2020. So one of the recurring themes of agenda in that research revolve around an item called data management. And the respondents indicated that the industry is sitting on a gold mine. What is that gold mine? It is data that we hold about the insureds. And based on that data alone, even if you don't get data from other sources, the data that the industry is sitting on, that each company, each insurance company is sitting on, is enough to grow the pie and retain that pie. Specifically on customer service and customer centricity, we would like to ask the big question: are we aware of our consumers? What are they telling us? What are the consumer views about the products that we are offering them in the market? What are their views about pricing? Are the pricing informed by the benefits that the consumers receive? Are our operational systems based on the data we have? What about the distribution processes and systems? Are we able to analyze trends and benchmark with the best? So really data, like you would have gold in a gold mine, should be warehoused and stored in a way that it can be mined and most of the respondents are challenging the industry. Can we do better? The beauty is that it is possible to mine data that is existing so that we can grow and expand the pie more than the way it is today, without even going to look for new customers. From the customers that we have, we can grow organically. The other information that came through that can transform the industry had to do with professionalism. And a lot of them were saying, look, a lot of people we have in the industry today are not properly trained. They are not properly developed as it was in the past. And it looks like training and development has become a cost instead of an investment. So industry is being challenged there that we need to invest in developing our professionals in the industry so that they can maintain the kind of ethical standards that attract and retain customers. We also came across respondents who said our management structures are not efficient and effective enough to grow the industry. So we need to have a relook there. With regard to ICT and digital platforms, the industry did give us this feedback that a lot of things that we do are not based on proper risk management. So can we do better there? The answer is yes. And lastly, the item on research, it is mentioned that we don't do enough research, that we can do better, so that the products we offer, the services we offer, should be based on information that is research-based. Let's go to the next slide. Now, based on that research, then we have questions that we want to ask the industry, and you as champions and captains of the industry, we would like you to think about these questions. Are you confident that you're providing superior customer service? How do you know you're doing it? What are your customers telling you? Are you responding to those customer queries? The next item there is on readiness for change. Are you ready to take charge of change? Are you ready to self-disrupt, or would you prefer to be disrupted from outside? How can you tell? And lastly, are you ready to take advantage of the emerging markets and position yourself to grow? These are questions that we are posing to you as captains and industry leaders. Isaac can take over from there.
Thank you very much.
Isaac, you are
Chair. Okay.
Isaac, you have 3 minutes.
Yeah. Thank you. Oh, thank you very much, Chair. Now, the issue of transformational building blocks, very important, like have already been mentioned there by my colleagues. But my focus this morning is just a few minutes to look at professional ethics as one of the transformational building blocks, has been mentioned, is professional efficacy. And central to any profession is the issue of ethics. And I think as we look at our industry and find the kind of growth pattern and trajectory that we are witnessing, we can say very clearly that our industry is steering between Skylar and Shalibdis, as we say. Shalibdis in our case being the whirlpool of the external environment, but Skylar could be that monster within us, within our insurance industry. And professional ethics are at the center, they are the kingpin, the axis around which professionalism is revolves, so that we are able to revolve in our own environment without any loss of energy or disturbing the surroundings. And it reaches a certain point now when we look at the growth and the position of the insurance industry, where inevitably we have to do some introspection and ask ourselves, we have been appraising all the external environment, appraising blames here and there, but what about ourselves? What about our own industry? What about our moral and ethical disposition? Could that be a bottleneck that is stifling our growth? And that is a question that we have to get into. We have got to get into a robust, a very frank, crucial dialogue relating the issue of the moral disposition of our professionals. When it comes to skills, we know that in Kenya, thanks to our primus inter pares, the Insurance Institute of Kenya, there's been a lot of development in terms of skills. All the years they have been there, that is the 72 years IIK has been in this market. They've had a lot of professionals developed, very many, compared even to in the region. We have also got quite a number of actuaries now that are coming up. So in terms of skills, we have practically all the skills that we need, but somehow we don't seem really to be growing our pie. We don't seem to be growing at all as an industry. So could it be something to do with our moral and ethical disposition? And when we look at the insurance industry, we know that the moral disposition is anchored in the very definition of our business, insurance. From very early on, it was defined that insurance is a business which is affected with public interest. Insurance is also a business of fiduciary trust. Insurance is also based on the fundamental principle of ius prima fidei, utmost good faith. And in turn, as far as the insurance industry itself and professionals are concerned, we are required from that very same principle to observe another principle, equum et bonum, to be fair, reasonable, and equitable in all our dealings with our stakeholders, the various publics that we have to deal with. And the big question is this how we have been treating all the various publics that we have had? And in this dialogue, we need really to change our narrative. When we look at our competitive dynamics, and it is there in all the research, we find that there is limited risk assessment. It's one of the problems that we have in the market. We have also got considerable undercutting. We have also got considerable fraud in the industry. Could it be that there is some complicity from within the industry? And all this begs the question of what is our professional ethics? Are we upholding them? Are we upholding our ethical standards as required? And as IIK now gets at the force of the law, this will be very, very critical to be looked into, because it could be one of the issues that is holding us back. Then the issue of regulatory compliance, of course, also enhances. Sorry, Mr. Chairman. Can I now finish then? What is needed is the moral leadership in our industry. We need to look at the type of leadership that we have, upholding ethical standards, our captains of the industry, and anybody who impacts on the insurance value chain. We need really to look into this issue. And what moral leadership means is that we have to do what is right, not what is easy. Perhaps for far too long, we have been doing what is easy, sweeping the moral compass under the carpet of ease and convenience. We need to change that narrative. We need to change the status quo so that we can be able to grow our business. Can we go to the next slide, please? As I finish, next slide. Richard, Mr. Oyale, okay. So we need to disrupt the status quo that we've been having. We need to enhance risk management in everything that we do, because that is our business. At the end of the day, we pay, of course, compensation for losses occurred, but we are concerned with the whole issue of hazard management. Then it is crucial that we get into this robust dialogue about our professional and moral disposition. And as we benchmark with the best locally and globally, which we have said we should also make sure that even as we get the example of what happens elsewhere, the issue of professionalism and professional ethics should be one of the issues that we really should focus on in our industry here. As industry captains, we should be champions of professional ethics in our market. And as a whole, as I said, all the players in the insurance industry, all the practitioners, anybody who impacts on the insurance value chain should raise the bar of moral platform. I think it behoves upon all of us to do that, not just an individual, not just looking at what we do as individual companies.
Thank you.
So let's, in conclusion, Mr. Chairman, sorry, we have to move together to build this vision for all of us, for it takes all of us, that is, to be committed and dedicated to doing what is right, not what is easy. Then we will have gotten our moral compass right and the North Star pointing to the right direction of flourishing our industry and our society. Thank you very much.
Thank you, Isaac and Tim, for that excellent presentation. Delegates on the one, we have comments that have been posted by delegates, and I think the very first one there is from Birian. I think it is Birian Akwiri, who is asking how can managers in the insurance industry be made responsible going forward for their actions individually or jointly with CEOs for charging what is apparently low rates. It's referring to undercutting. And there's a response from Diana Sawe from IRA. Diana has indicated on Akwiri's comment, the insurance amendment bill, professional bill, is a game changer. IIK will need to develop and enforce professional code of conduct, which will enable all registered certified insurance professionals to set standards. This will include certification of good conduct and good standing within the IIK annually. I don't know whether Director IIK, you want to say, give a comment on this? Agnes?
Yes, that is going to help because we will be able to discipline errant members, and once we have this on board, we will be in a position to make sure that all our professionals are under the umbrella, and when they are all in there, it is now easy for us to be able to see who is who. And I think even as Birian has asked that question of how do we know the issues of professionalism, we will have a number in the, once we have the legal recognition, whereby professionals have a number which they put somewhere in terms of what they are doing, such that if something goes wrong, we will be able to trace which professional did this. Thank you very much.
Thank you, Agnes. Then I think the same comment was coming for IRA. And Biran is asking, in the advent of the Insurance Profession Amendment Bill and the possible enactment, how will IRA support the new dispensation by empowering professionals? I want to ask my colleague Kalai to give a comment.
Thank you, Robert. I think the coming to being of this IIK professional bill will be a very welcome idea. As you know, currently the way the Insurance Act is, it requires professionals to, people being managers, insurance companies, to be professionals. But now the question is, if that professional has done anything which is unprofessional, which professional body legally determines that he has done that and can take action? which is now what we need to, we'll be able to liaise with the IIK to make sure that if IIK has taken action against a professional for professional misconduct, then that person will be forbidden from working in the industry. From the discussions you can see there are a lot of issues. We are talking about a lot of issues in the industry on misconduct. And I think this will be the solution for that. Thank you.
Thank you, Kalai. And maybe Agnes, just a final quick comment on the request by members for the presentation, and I think the issues about, I think some guidance you're providing on the wall. Agnes?
Sorry, I'm not able to see the issues on my...
The issue is, basically, the issue was the request to share the presentations. And I think there's a comment from your secretariat that please fill the form to allow IIK procure certificate and CPD. I thought you could just reinforce that so that I invite the next presenter.
Okay. I think I'm not...
I
can comment later.
No problem. Let's proceed to the next presentation. That is for Alex, George, and Richard. Thank you so much for your presentation. I want now to invite the next presenter to take us through the presentation. That is Lawrence. Lawrence, can you take the floor to take us through your next presentation?
Excellent. Okay, thank you very much, and good morning, everyone. I am very pleased to be with you today. So hopefully people can see the slide which I'm sharing at the moment. Everyone can see that? Yes.
Yes.
Okay. Excellent. I know that it's working there. So good morning, everyone. Thank you very much for inviting me. My name is Lawrence Smith, has been mentioned earlier. I am the Regional Director for Africa at the Chartered Insurance Institute, and I'm going to be sharing some best practice from regional and international insurance markets with you. Insurance has been described as one of the few professions which is inherently international in its nature. This observation was made by the Chief Executive of the CI, Sian Fisher, recognizing that unlike many other professions, the essence of risk and risk management is largely universal. However, because it's invisible, it's often easy for policymakers to underestimate the role of insurance in oiling the wheels of the global economy. Now, on this workshop, I'm sure that everybody is very aware that the contribution that insurance makes to economic and social development is enormous. Without insurance, businesses wouldn't have the confidence to invest and to grow. International trade would come to a standstill, and families and individuals would suffer the insecurity of being one unfortunate event away from financial disaster. The high-level numbers around the world are impressive enough. Insurance accounts for 6.1% of global GDP. The world's insurers manage over $5 trillion in premiums, and an estimated 5 million people are employed either within insurance companies or within the insurance supply chain. But it's when you look at the trends on a country-by-country basis that you really dramatically see the impact of insurance. Many underdeveloped economies have struggled to reach takeoff until they have a robust, viable insurance sector. Insurance is often the key to rapid and sustainable economic momentum. It creates wealth, it lifts populations out of poverty, and it diversifies the number of employment opportunities that are available to people in the economy. So in this short talk, I'd like to share some of the practices that
Richard, are you able to, Lawrence, are you able to move your slides?
I beg your pardon?
You will move your slides.
I'm happy to move my slides. I'm still on the first one at the moment. So in this short talk, I'd like to share some of the practices we've seen around the world as insurance firms have built a pivotal role for themselves especially in regions with fast developing economies. And based on CI research, I'd like to propose a number of metrics and measures that insurance companies could adopt, which will help to show the value that you create within that ecosystem of customers and suppliers and regulators and policymakers and so on. These metrics are informed by the Circle of Trust model, which was at the heart of the CI's publication, A World of Promise, Building a Trusted International Insurance and Financial Planning Profession, that I edited earlier this year. This report arose from conversations that I had with executive officers running each of the CI's 39 affiliated institutes, as well as insurance practitioners and chief executive officers in places such as India and the Middle East and around Africa and in Hong Kong, as well as people who are also involved in insurance regulation and education. And what I found out is there is a huge amount to celebrate. The mission to build trust has clearly resonated and is widely recognized as being essential for economic and social and business reasons. So looking at my first slide here, you can see the circle of trust, which is defined by two axes, and their intersection creates four segments. The horizontal axis relates to people, from insurance professionals on the left to insurance customers on the right. The vertical axis relates to the change that is being pioneered, the sorts of activities that we saw in our research, from spreading good practice at the top to making a step change that shapes the world of tomorrow in the bottom quadrants. From our research, there are two priorities in these four segments that help to contribute towards a vibrant, dynamic and prosperous profession. And those are the 8 that are on the slides here, and those are what I'll now speak about. So item 1 up in the top left-hand side is about talent, specifically about closer ties between the insurance profession and education, colleges, universities, and so forth. The benefits of this include mentoring future leaders and embedding a habit of lifelong learning and enabling people to make a seamless transition from their studies at school and college to their careers. So how can we as insurance professionals measure our effectiveness in this area? A good start, which we do in London, would be profiling the attractiveness of insurance to top graduates and tracking the number of students each year who enter insurance from leading universities and colleges. Secondly, we come to professional standards. This covers the universal values of competence and integrity and a duty of care, as well as understanding how ethics are embedded when so much activity takes place in the digital sphere. There are many relevant measures we seek to develop to track this priority. For example, what proportion of the insurance workforce are members of a professional body? In the UK, the answer is around 35%, although it's far higher in financial planning. Another measure which is important to the UK regulator is monitoring the number of upheld complaints and also disciplinary action. Thirdly, moving across to the right, let's look at insurance accessibility, by which I mean simplified products, previous speakers have touched on this, that are easily explained and available on a frictionless basis using microinsurance principles. A great measure here is to track the insurance penetration within the population, and you saw slides on this earlier. The average number of insurance policies per adult, or the proportion of insurance that's wrapped up in, that makes part of the GDP. In Europe, the average is 9 to 11%, as was said earlier. In Kenya, it's about 3%, so plenty of opportunity there. Fourthly, in terms of building a trusted profession, the Circle of Trust looks at the cross-border experiences that customers have. This is particularly important with businesses or high net worth individuals who are mobile across borders. This is key because in a social media era, a bad experience on one side of the world can go viral in moments. In today's world, a positive cross-border experience would involve consistency, the use of data and insight, and rolling out and piloting innovation so that experiences keep pace with what customers expect from other sectors with which they engage, such as online retailing. Any insurer that's active in multiple countries should be tracking whether key customer service measures such as response times and claim settlements and customer satisfaction are consistent from one country to another. If you have a shortfall in one territory, that can really have repercussions elsewhere. Moving below the horizontal, we come to partnerships in the insurance ecosystem. Now, advisors, we've found, maintain their value through a knowledge edge and an ability to build insight into their process. There are many examples around the world of collaborative efforts amongst insurers and advisors to deliver a common good through partnerships. For example, China's Greater Bay Area initiative, which built confidence in the value of insurance through a single platform, a reputable platform, with a manager and a free of charge access for all insured people to mediation and arbitration services. These have been the foundations of an initiative to build a strong, sustainable insurance sector for 66 million people living in the 9+2 region. And Benjamin Chang, Aon's regional managing director in the Greater Bay Area of China, has been a leading force. He wrote about it in our 2019 publication, A World of Risk. I strongly recommend that you set targets and measure the number of collaborative initiatives in which multiple organizations are involved that build and deliver a public benefit. Sixthly, we come to technology disruption, using the power of the internet to raise the competence of practitioners through an anytime, anywhere approach to learning, and also more accurate and real-time assessments of knowledge. How many professionals in your companies have attained the highest levels of learning as exemplified through qualifications such as chartered or fellowship? Moving into the final part of the circle of trust, we come across to the insurance profession's contribution to protecting the environment, something that is very important to many generations, particularly younger generations as well in our research. The United Nations has published 4 principles for sustainable insurance, which you may be aware. I believe that compliance with these principles can be a springboard to success for insurers that want to demonstrate their contribution to our society and environmental well-being. And finally, we have social relevance. This is embracing diversity, and as one of the last decade's leading insurance thinkers in India said, the triple bottom line. He wrote about this in a World of Promise. This is measuring the composition of the insurance workforce from a diversity perspective. Excellent measure that really helps to reinforce the extent to which it mirrors wider society. So these are secondary metrics, but they're all subsidiary to the overall metric of building public trust. And that's where I'd like to focus the second half of my remarks. Now, in the UK, we were very keen on the elements that underpin trust. And we commissioned academics who specialized in trust to explore this topic. The result of their work was a definition of trust that involves 9 parts: loyalty, confidence, speed, protection, ease, respect, price, control, and relationships. And we started, and we've published, and this is available on our website, I can circulate it afterwards, our Public Trust Annual Benchmark. And this is UK data. You're welcome to kind of look at it and think how it may apply in Kenya. And it was driven by a series of statements which fleshed out each of the themes that we then spoke to insurance consumers about. For example, to understand about confidence, we asked them whether they were confident that the company handles complaints professionally and fairly, or whether insurers assess your risk individually. For each, we use statements such as these. My questions are answered quickly and easily, for ease. And for loyalty, we asked the question, the premium doesn't increase because I'm not a new customer anymore. So question sets such as these were drafted for individual customers and for small and medium-sized businesses. And the results you can see here. So along the horizontal axis, you've got the relative importance of that factor. And across the vertical axis, you can see the perceived performance of the insurance sector in the eyes of consumers. And the size of the bubble shows the relative, what the academics call the opportunity score. So what did we learn? We learned that the most important driver for consumers when it comes to buying insurance is confidence that they're going to have good cover with claims settled quickly, and also loyalty. So you can see those 2 things at the top, both for males and for females. So 74% was the overall score, opportunity score given to loyalty. And at each step, there was a sizable gap between the customer's expectation and the performance of the insurers. Now, consumers do not welcome the aggravation of having to shop around and switching insurer, and therefore they really expect to be rewarded for their loyalty remaining with the same provider. But they feel that this is not currently being reciprocated. This theme of loyalty, again, is important for both males and for females. So delving further into the data, we find that this challenge is often exacerbated by age as well. Older customers tend to have higher expectations and are more likely to think that suppliers are not delivering as they should. Turning to small and medium-sized enterprises, we see that the same theme still rings loud. That Institute of Customer Service, who ran this research for the CI, highlighted loyalty again as the core area where insurers should consider future investment, an opportunity score, as you can see, of 8.63, which speaks for itself. So let's look briefly now at opportunities throughout Africa. Now, it's increasingly clear that insurers are doing incredible things. Over the past few months in my role as the regional director for Africa, I've spoken with all the major employers throughout Africa who have a relationship with the CI, and we'll be sharing the full results later this year in a groundbreaking publication called A Continent of Promise, which celebrates some of the remarkable work around Africa to build a trusted insurance planning profession. We're aiming to launch this publication at the end of October, and I'd encourage everybody to go onto the CI website and download a copy of it. But in the meantime, I'd like to mention some of the remarkable things which we uncovered. So in Tanzania, for example, we found that Britam Insurance has invested heavily in a graduate training program, attracting top talent from premier universities with a fast-track program that exposes them to all facets of insurance in their business in a really concentrated period and providing an accelerated path. What we've really found is that young people, there's a generation coming through, particularly in Tanzania there and also in Africa, who are very technologically literate, keen to learn, and very ambitious for their careers. In the same country, Tanri, which is the major, become one of the continent's major reinsurers, trades with over 250 highly respected insurance companies, and it has a strategy that has placed professionalism as one of its core values. In fact, the first value on its list of 3, published right at the top on its website. In Zambia, the Aon company Minet provides and promotes professional qualifications, and it recently organised a webinar for insurers throughout the country in which candidates who are studying for CI exams had the opportunity to quiz me and my colleagues from the CI about how they should approach their studies, especially aspects such as coursework assessment, which can be a new experience which is not necessarily featured in the general education system. In Eritrea, the National Insurance Corporation has been a strong advocate of modern, internationally accepted standards of governance, and it publishes these widely, a commitment rooted in its core values and beliefs, strict policies around conflict of interest, audit, and compliance. In Malawi, Nico General Insurance has established 5 core values: collaboration, care, innovation, health and safety, and professionalism. And it instills all its staff the philosophy that professionalism means tailoring insurance arrangements to the needs of clients, never using a one-size-fits-all approach. In countries throughout much of East Africa, we found UAP Old Mutual is pioneering the practice of being a close partner in local communities and being fair to its competitors and honest with customers and employees. But throughout Africa, it's not just the insurers and the brokers who are working to create a thriving profession. The CI has 13 affiliates throughout the continent, and they're also playing their part. In South Africa, our affiliate partner, the Insurance Institute of South Africa, has launched an executive development program and created an e-learning platform complete with virtual workshops that reached 1,200 insurance practitioners in its first 3 months. In Uganda, the Insurance Training College is pushing the boundaries and really making sure that insurance is relevant to changing needs with high-profile work and courses and programs in fields such as cyber insurance, anti-money laundering, bank assurance, marine insurance, and combating the funding of terrorism. And of course, your own remarkable Insurance Institute of Kenya, which is a powerful advocate of the value of continuing professional development for insurance practitioners to ensure that learning and knowledge stays current and relevant. And as you all know, the IIK is passionate about creating opportunities to learn within professional networks such as this one, and ensuring that insurance leadership teams and board members are constantly aware of upcoming changes to regulation and technology and similar matters. In all of these examples, there's one theme that underlies all of them, I think, and that is about treating customers fairly. Our customers are not spending their evenings and weekends becoming insurance experts. This may surprise some of the more enthusiastic insurance colleagues at the CI, but most people have other interests other than insurance in their lives. Now, this means that they're heavily dependent on how we, as a profession, direct and support and advise them. And that means thinking about what their needs are. It doesn't mean starting off by thinking about how much money can be made from a customer. Whenever Disney begins the production of a new movie, everyone on the set is single-mindedly concerned with telling the best, most enjoyable story to the highest possible standard. At that point, they aren't thinking about how much money they'll make. Making the money is the result of delighting their audiences and having the audiences returning. The same with successful sports teams or companies such as Apple, which recently became the world's first $2 trillion market cap company. Steve Jobs was obsessed about innovation and quality and branding. He became a billionaire as a result of these motives. If he'd had different motives, there would surely have been a different result. According to recent research of 18 sectors by consultants Bain & Company, tracking loyalty, engagement and enthusiasm, the sectors with loyalty are number one, grocery stores at 49%. This is followed by online shopping retailers at 47%, department stores at 46%, search engines and social media firms at 43%, and computer software at 32%. The good news for the insurance sector is that we're within touching distance of these benchmarks. For homeowner insurance, loyalty is at 27%, and for auto insurance, it's 35%. I suspect this reflects, now there's still obviously plenty to go, but plenty of sectors were lower down their index than this. And I think that this shows and reflects the work of many insurance professionals over the past decade who've been challenging the historic reputation for being faceless, for being penny pinching, and have actually been paying the vast majority of valid, uncontested claims very quickly to help customers to get back on their feet. Treating customers fairly means we must continuously strive to be better at understanding the public's needs and expectations, because these don't stay the same over time. We can only do this by listening carefully. And that's the reason that many of history's most successful business leaders have set aside at least one day every month to be on the front line, out of their chief executive's office, speaking with customers and appreciating their concerns. It also means designing and reinventing products so that they reflect modern society. Earlier speakers mentioned this as well. So not just dealing with legacy products that are designed the same way they were 50 years ago, but having products that now reflect the gender diversity of modern society and also changing patterns of work and leisure. It also means being unafraid to say from time to time that a particular product is not right for a particular customer. That's why customer retention has always been my favorite benchmark in the insurance sector. It costs a small fortune to acquire a new customer, and all that money is just forfeit if the customer leaves after 12 to 18 months. General insurers that have fostered customer loyalty should aim to keep customers for 10 years, in my view, and that will vary by product type and across customer segments, and some it will be more. For life insurance, customers can stay loyal for twice that period. The most far-sighted and inspirational companies now have in their DNA a view of customers that's about a relationship. It's not transactional. It shouldn't be a matter of saying they pay us, we provide the insurance, that's the end of the story. Instead, customers should be seen as,
if you kindly conclude.
I will conclude, yes. Customers are now partners in a joint ambition to create a wonderful, socially valuable result. Collaborators in a bold enterprise. They're not just customers for a finite period. Customers are constantly involved in giving feedback, sharing ideas, being involved in innovation and pilots. And I'll just close with the words of the musician, Brian Eno, who has worked with numerous icons such as David Bowie, and he once said that every collaboration helps me to grow. And when I think of benchmarking best practice, I think collaboration is a very fitting note on which to close. Thank you very much, Mr. Chairman, and that's my remarks concluded.
Thank you, Lawrence, for that insightful presentation and the issues that you've shared, especially the journey that you're supposed to be working to be able to create the change and grow the pie as per the theme of the conference. You have quite a number of issues that you've shared. We missed out on your slides. at the tail end of the presentation, but members, I'm sure they will be shared with all the delegates to be able to catch up with what Lawrence was talking about. I don't know if Chris, Alex, if you could be ready, please. In the meantime, delegates, if you have any comment or question, you could raise to the first two speakers. I know there is the director has responded to the issue delegates were asking about they were asking about the
forms,
the issue of certificates. Yeah. And that has been clarified. You just need to fill the link that has been shared by Mercy, and they will be communicated to you for purpose of getting the contacts correctly. So members, you could just note that and fill it based on the link that has been shared. So any comment from delegates on the first two presentations as we wait for Alex? In the meantime, Alex could be preparing to come on board. I'm not seeing any reaction from delegates. Alex, can you hear me? I suggest we don't go for the break. We have saved quite a lot on time. We will proceed to the next presentation. Lawrence, you will continue with your next presentation.
I beg your pardon. You want me to do my second presentation, or is that later?
Sorry, I wanted to, if you could proceed with the next presentation. Alex does not seem to be on board yet. Okay, and straight away, or do you want to have a break? Straight away.
Okay, straight away. Right. No problem at all. Okay, so my second presentation is looking at the key issues that are facing insurance CEOs over the next decade. So I'm going to, first of all, share second slide with you. Hopefully you can see this slide called A Changing World.
The slide is not very clear. Lawrence, are you able to make it bigger on slideshow?
Oh, I don't think I can, no. Are other people having a problem with the slide? I'll just try sharing it. I'll try sharing it one more time and see if it comes out. Is this better? Okay. Okay. It's if you can't see the slide, I'll circulate it afterwards.
Lawrence, we are okay. We can see the slide. The slide is small unless you make it 80, but it's okay.
Okay, perfect. Okay, so so this is about the key issues facing chief executives in the insurance sector over the next decade. So the most dangerous trap for the chief executive of any successful firm in any sector is to think that the firm is invulnerable and is going to be immune to changes in consumer behavior or technology. So my slide here shows the top 10 companies in the world in the 1950s. And just to pick a company on that list at random, number 6 in the list, a company called Amoco. Now, at its peak, Amoco, which was an oil company, it had plants and oil wells in over 30 countries in Africa and in Asia and in South America, and employed a workforce that was large enough to fill 3 vast soccer stadiums. It owned and operated 12 refineries in the United States. It had 12,000 miles of crude oil pipelines. It produced 13 million tons of chemicals every year. And yet, less than half a century later, Amoco, this giant of the American economy, had plummeted far from the top 10 list, as had many of the others. Chrysler, Goodyear, Firestone, Standard Oil, all of them had fallen victim to unforeseen events. Almost every firm in the top 10 in the 1950s had been downsized or acquired or broken up or outsourced or liquidated. some sort of event had happened that had relegated them from the top 10. And by the year 2000, most of the slots in the top 10 were now occupied by brands that were more in tune with the world of the new decade, the new century, the new millennium. So that you no longer saw heavy industry in the league. Instead, you saw a lot of retailers such as Walmart and Target and Sears, and technology in the form of IBM, financial services in the form of Bank of America. All were making their imprint on the consumer wallet in more of a consumer-orientated rather than a manufacturing world. So if you'd been looking at this list in the year 2000, you might have said to yourself, fantastic, this is now the new top 10. These are now the firms that are timeless. These are the firms that are indestructible. But far from it. In fact, the speed of change was accelerating. Roll the clock forward and just 2 more decades, and actually, again, all of those top 10 firms were throw out the old, bring in the new. They were all relegated from the top 10 list, and now looming over the business world, you see the high-tech giants such as Apple and Amazon and Google and Microsoft and Facebook. And along with other kind of 21st century shares such as, or stocks, such as Berkshire Hathaway and pharmaceuticals in the form of Johnson & Johnson. Are these now the new immortal firms? Will these be the ones that will find a way to survive and thrive, immune to disruption? Or if we were to get in our time machine and come back in the year 2030 or even 2050, would we find that those highly craved positions, that those leaders have now disappeared in the face of newer, nimbler challenges that are more in tune with the future horizon? Could we see at this very moment, somewhere in the world, there's a fledgling entrepreneur who's sitting in his or her garage, taking a first order from the first customer. And when we come back in 20 years' time, we might see that they are now sitting proudly atop the pile. So it was this changeability that led the board of the Chartered Insurance Institute in 2015 or 2019, sorry, to consider what are the issues facing the insurance sector over the next 2 decades. Firstly, the board thought about some of the features. What is the world going to look like in 2040? If we did get into our time machine and we set it to 20 years in the future and then we jumped out, what sort of things would we see? So some of the things that the CI board thought you might see would be, for example, the end of cash. They actually thought you might see life expectancy that's been going up, that might be going into reverse. They thought that half the population of the planet may be vegan or vegetarian. And also, in fact, one of the board members thought we'd have had first contact with extraterrestrial life by then. That were the board's views. I've also written about some of the other trends which I see over the next few decades. I think we'll increasingly see things like homes that can clean themselves. We'll see the commercialization, this is one of my theories, of spider webs. Given the tensile strength of spider webs, if you could actually manufacture metals from those, it would probably destroy the steel industry as we know it today. I think we'll see things like non-dairy milk becoming more popular, oat milk and soy milk and almond milk and rice milk. I think we'll be starting to explore the parts of the planet that are beyond exploration at the moment, which is the deepest depths of the ocean. And we may well find, this is one of my other theories, that Greta Thunberg could be running the United Nations, and who knows who will be in the White House. I'd be fascinated to know your own predictions for the next 20 years. We certainly know it's going to be unpredictable. 12 months ago, who would have forecast a global pandemic and social distancing and lockdown? Not even hardly heard of those terms. So I'd be very happy to be invited back in 20 years. We can see how many of these predictions turn out true. And feel free to share some of your own thoughts in the chat. Returning to the CI board discussion, so they thought about the general evolution of society, but the next challenge was to think about what does this mean for the insurance profession? And it said to itself, what are the hot issues that will be on the agenda of CEOs and CFOs and chief marketing officers and IT directors of insurance companies over the next 2 decades? So one thing they felt we can be confident about is that uncertainty is the new normal. First of all, even just natural disasters, they felt they're going to become more frequent. A lot of that could be resulted from climate change, but also we're probably now due for the next major volcanic eruption or some catastrophic earthquake. But also when you're looking at risks, businesses face risks that scarcely existed a few years ago. Hello?
Lawrence, if you could share your screen, please.
Oh, I don't have a slide for this. I'm just talking. So, but if it's helpful, I'm happy to create a slide and to share that afterwards that summarizes the key points. But yes, I didn't prepare a slide for this. So cybersecurity is an emerging risk. A few years ago, the only way your data could be stolen is if a thief or a blackmailer entered your building out of hours. Now they just have to find out a weakness in your IT system and hack in. Added to this, in many regions and countries, there are the risks of political or economic instability. How do insurers take account of these factors when they design products and set prices that are going to be relevant in such a fast changing world? The next issue identified by the CI board for insurance companies is the remorseless drive for efficiency. Now, this is being driven by intense competition, by claims ratios, by thin margins. All of these are putting huge pressure on their operations. Technology can reduce costs, but also it leads to new costs. Some insurers now employ more IT professionals than they employ actuaries and underwriters. IT can now easily consume 20% of an insurance company's operating costs and 50% of its capital costs. Added to this challenge, the rise of home working has converted many IT fixed costs into variable costs that are harder to control. And this places greater priority on the need for boards and CEOs to be efficient custodians of shareholder funds. The third issue on the board agenda relates to recruitment and retention. People, as we all know, are a key asset, especially in a service industry and especially in a period of rapid change. Getting the right people in the right jobs is a never-ending challenge. A world-class underwriter can be just as valuable to an insurance company as Lionel Messi has been to Barcelona. Brokers will only maintain their credibility with clients if they're able to attract and retain people who have the knowledge and skills to build long-term trusted relationships with their clients. Now, of course, technology is a massive driver of change, and that's going to continue at pace. I'm sure there's no dispute about that. And it's actually changing the very essence of insurance in many ways. The sector is starting to evolve from providing protection in case things go wrong to actually increasing the probability they will go right. That's the evolution from covering risk to preventing risk. Technology has also raised the question of what is an insurable asset. Within living memory, there was a time when 85% of assets were physical. You could kind of touch them and hold them. Now, experts tell us that the same proportion in many companies are intangible. These are assets such as intellectual property or brand reputation. Insurance policies, if they are to remain relevant, need to reflect this and need to provide coverage for the actual risks that keep CEOs awake and can wreck their businesses and livelihoods. Increasingly, these risks are intangibles. When we look at society, we look at these assets in society, we also see that ownership patterns are changing. And this is something that the board of the CI was very conscious of. Traditionally, insurance has depended on companies or individuals owning things. Now, this is in many areas becoming a highly inefficient model. The average drill is used for 13 minutes. Why do so many people need to own their own drill? In Switzerland, there are 1.4 million trailers. If you had efficient technology and sharing, you'd only need 19,000. Generation Y rent their music and movies on streaming platforms rather than owning vinyls and DVDs. Over the coming decade, we'll see the sharing economy spread into many other fields, challenging the very concept of ownership as technology enables this sharing. Two of the other dramatic consequences of technology revolution are, first of all, the Internet of Things, and secondly, data overload. Let's have a look at the Internet of Things, first of all. When everyday household devices are all connected to the internet, the opportunities and threats to the insurance profession are vast. Since most household damage occurs when the insured asset is left unattended, you do have enormous scope. Can insurance work with technology innovation that minimizes the damage to insured items? You can have sensors in buildings that cut off the water as soon as there's a leak. If that happens, does that diminish the need for insurance, or does it reinforce its ability to deliver value? And even more of a challenge is data overload. Computing power is turning us all in the insurance profession into armchair data scientists. Famously, there's more processing power in an average phone than in the Apollo 11 that took 3 astronauts 250,000 miles to the moon. According to Dell, more data has been generated and processed in the last 12 months than in the rest of human history combined. What does this mean to how insurers assess and price risk? As we become more sophisticated in our ability to price risk, what will that do to social exclusion? Will you see the emergence of a cohort of the population whose risk factors we can quantify so tightly that they effectively become uninsurable? Could you find that you now have a pool of people in society whose risks you can't actually put into the same pool as everyone else? Now, finally, I'd like to, in this session about technology, I'd like just to talk about the issue of claims. It's remiss to talk about technology without talking about claims, because that's such a core part of an insurer's cost base and indeed its value, and especially fraud and criminally organised fraud. Every time we see a technology advance, there are people out there who can exploit this to defraud insurers, and technology is also providing insurers with the means to fight back. Now, I don't have the figures for Kenya, but in the UK, the eye-watering cost of insurance fraud is nearly $2 billion equivalent every year. And that's the reason why insurers are investing around $300 million each year to identify fraud. Organised criminal gangs setting up crash for cash style motoring scams, and even law-abiding citizens seem to regard faceless insurance companies as fair game and will happily supply false information. The biggest recent claim I've seen in the UK was for nearly $2 million, which was lodged by three insurers by a grieving widow whose husband had died of brain fever on an overseas business trip, but he had actually reappeared in the UK under an assumed name. And what's happening with technology is that the ability for people to understand the system, for fraudsters to understand the system, to test variables, to set up multiple IDs, test scenarios until they identify those which can bypass the insurance algorithms, submit fake documents during verification checks and so forth. There's also been a rise in the UK in what we call ghost brokers. Fraudulent insurance policies are sold by illegal insurance advisors carrying the logos of genuine insurance customers and are sold to the end customers. But the good news is that as fraudsters grow more sophisticated, traditional methods used by insurers are becoming ineffectual, but new methods are coming to the fore. This is particularly important because actually in the old days in the UK where we had high street brokers, then they could at least look a customer in the eye to get suspicious. But when you've got digital business models, how can you also exercise the same due diligence? So some of the things that are happening in the UK, triangulation of data from multiple sources, including from data bureaus, from public records, to look for anomalies, in particular mismatches between the data supplied in an application and the data held on file. Technology is also assisting with cross-industry anti-fraud collaboration between insurers. Device tracking is enabling firms to highlight multiple transactions from a single source, be it a single tablet or a single phone or a single laptop, regardless of factors that can be manipulated, such as the user credentials. And pioneering analytics are now being used to follow the activities of suspected fraudsters operating across multiple seemingly unrelated accounts. We're using AI in call centers, which is being programmed to flag unusual behavior that can be manifest in the most innocuous ways, vocabulary and intonation and voice patterns and other emotional cues that our telematic systems can pick up. So setting aside the issue of fraud, the most widespread impact of technology revolution is also that it has driven customer expectations into the stratosphere. Customers now approach their use of insurance not with their past experience of insurance, but actually with their experiences of, for example, using e-retailers, and therefore they are really expecting choice and immediacy and fairness, because that is how they've been trained to think in our digital world. And these are not unreasonable demands, and insurers must rise to the challenge. So a few years ago, I wrote a book entitled Turbocharged Strategy, in which I highlighted the need for 21st century companies, especially those with a broad customer base, to make sure they had a compelling proposition. And that meant boldness. They needed to be prepared to uproot the status quo. I looked at a healthcare innovator, designed healthcare diagnostics, actually thrown away how it had operated in the past, and developed a new system based on new technology that wasn't mired in the restraints of existing arrangements. They were all keen to demonstrate economic value, showing that every dollar spent on their service, the customer was receiving a value multiplier of 4 or 5 times what the cost was. But ultimately, it was all founded on the brand promise, and that is really how customer loyalty gets embedded. We're all aware from our lives as consumers and citizens that brands have distinctive personalities, and this, the CI very much said in its future thinking, is going to become more to the fore and also more embedded in the world of insurance, even in business-to-business insurance. In the modern world, we're all surrounded by brands. In the first few minutes of every day, we experience so many brands, the brand of our bed, toothpaste, our clothing, our breakfast cereal, our television, our cell phone, our internet service provider, our home appliances. The window, and we see billboards and shop fronts and electric signage. Estimates suggest that the average adult in the modern world is exposed to over 2,000 brand messages each and every day. Cutting through this forest of messages means appealing to your customers on both an emotional and rational level. It means having a brand that is associated with all those things that really reinforce brand loyalty: value, impact, governance, track record, simplicity, and people. That at least, these were the elements in a recent series of focus groups, consumer focus groups, in which we're involved in the UK to understand the issue of consumer loyalty. I'll just say a couple of words about each one. So first of all, values. So people, we found, are more likely to use the services of organisations that they believe are underpinned by powerful, deeply held values. That's why I'd encourage all insurance companies to set out and document your brand values and publish them openly on your website, so you can really be held to account. Secondly, impact. People trust brands that have, in living memory, delivered improvements and had an impact on their day-to-day lifestyle. So one participant in the focus group said, "I shudder to think how difficult it used to be to get basic stuff done before Silicon Valley helped me to find simple information, which I now take for granted." So by the same token, insurers need to think to show how we've made an impact, how we've given families the resilience to face the future, how we've given firms the confidence to invest in trade. We don't need to be shy about proclaiming that impact. Thirdly, governance. So we found that when people, consumers, perceive that products and services are provided by firms that have got strong regulation or governance, then again, the customers have more of a comfort blanket around dealing with that organisation. Next of all, track record. People are more inclined to trust organisations that are very open and transparent about their track record. That's why airlines often talk about their safety record. One person said, "Of course I trust British Airways. I take my children to Spain every year. I wouldn't do that if I didn't trust them." Next of all, simplicity. We found that customers have greater empathy and affinity with brands that have a simple proposition. If a brand is associated with coffee or theme parks or chocolate biscuits, then we trust them to do that properly. That's their core expertise. That's what they understand. They're not spreading themselves thinly across lots of different services. Their brand is associated very strongly with one clear area of expertise. And above all, we found a brand is about its people. Trust rises when firms are perceived to being world-class in looking after the well-being of their staff. So if you look, for example, at the corporate vision of Levi Jeans, it is people love our clothes and trust our people. Adidas also has one of its core values about its people, diversity. It says, "We know it takes people with different ideas, strengths, interests, and cultural backgrounds to make our company succeed. We encourage healthy debate and difference of opinions." Customers seem to believe that if a company treats its staff well, there's going to be a rub-off to everyone else they come into contact with. If they treat their staff horribly, the news will no doubt seep out and customers won't want anything to do with them. And that's really the note on which I'd like to close. Over the next decade, I foresee the issue of staff capability and competence will really rise up the chief executive agenda. It may be that there will be fewer professionals in insurance due to automation. That's certainly one of the themes that the CI board foresaw. But the ones that remain in the market will need greater level of expertise to deal with their customers, to compete, to be successful. Successful insurers won't just be those that have got vast amounts of capital. It will be those with a workforce of trained professionals who can adapt and innovate and challenge. That's why advisory skills are going to rise to the fore and may well eventually outweigh knowledge skills, especially because knowledge is more freely available than ever at the push of a button. With AI taking over routine jobs, it may not be long until half the roles in our sector have a strong advisory element. And this will give rise to what at the CI we have called the complete professional. In the same way that medics, it's not just enough as a medic to understand about medicine, you need to have a soothing bedside manner. Or lawyers don't just need to understand the law, but they need the skills of persuasion in front of a jury. And we foresee that the complete insurance professional in the 20s and the 30s won't just be someone who can recite all the risk factors from memory. It'll be someone who can listen, who can interrogate, who can communicate, who can apply knowledge. Individuals who hold a full list of A-star certificates but don't have that emotional intelligence or behavioural ability will struggle and will find it really hard to deal with unpredictable circumstances, and that means they will be unable to fulfil their professional obligations. That's why at the CI we're promoting the concept of the chartered ethos. At the heart of this is courage, the courage to stick with your convictions and speak your mind. None of us have the monopoly of wisdom, and successful CEOs in the 2020s will increasingly need to have a culture of openness, participation, collaboration in their organizations to get all of that, pull all of that wisdom and knowledge throughout their organization so that they can blend the insights and experiences of every one of us so that their organization can survive during turbulent times. And that's why, coming back to my list of the top 10, hopefully, if we're looking at that again in 2030 or 2040, when we revisit the list of the world's top 10 organizations, let's hope that one of Africa's finest will be represented in its ranks. Thank you very much. That's my views on key issues facing chief executives in the insurance sector in the next decade. Thank you very much, Mr. Chairman.
Thank you, Lawrence, for that insightful presentation. Just before I recap of some of the issues that we've gone through, I want you to respond to a few of the comments that are on the chat. The first comment there is, I like your insight, Mr. Smith. Give us more insights on how to sell insurance to Generation Y and Z.
So yes, excellent question. I mean, it's always difficult to kind of generalize about different generations. But one of the things that I find increasingly is that people like to hear, and this is particularly probably Generation Y and Z, but maybe all generations, like to see stories and case studies. And so one of the things that in the UK we increasingly do is, rather than just talk about insurance in the abstract or in theory or just talk about numbers, we'll actually get testimonials from individuals and talk about the difference that insurance made to their lives, where it helped them out. What we find is that people now no longer particularly kind of trust what big corporations say, but they will trust what their neighbours say. Individuals, your customers whose lives you've helped to kind of turn around, you've helped build their financial resilience, you've rescued their businesses. Many of those customers may be delighted to kind of talk about their experiences. And in the UK, we're using a lot of those case studies, sometimes even kind of creating social media clips around them, obviously with the permission of the people concerned, in a digestible form. Do you want me to go on with the next question, Mr. Chairman? I see there's a question about techno-savvy, or is that okay as an answer for the first question, or do you have a follow-up on that?
It's a point that...
Sorry, Lawrence. I think the first question came from Simon Gitonga, and I think you ably handled that. The next question is from Richard. I think is a comment. Discuss techno-savvy digital underwriting risks, including digital policy contract issue.
Yes. So, I mean, I touched on that briefly, but yes, certainly in the UK, we are using far more risk factors to do underwriting than has ever been the case before. Yeah, thinking about when I started my career, maybe there were kind of 4 or 5 risk factors that you might take into account. Now, sometimes from different sources, we can be using 10 times those numbers. So what that means is that's got some benefits to it, but also it means often massive investment in systems and technology, and also potentially big issues around data protection and consent as well. And so in the UK, the CII, obviously we're not an insurance company, but we're there to advocate standards. We are doing a lot of work with the regulator at the moment to work out how you get that balance right between the ability to use this vast amount of data plus consumer protection and privacy concerns as well. One of the other things that we're facing and that we're thinking about is, again, to build standards into insurance companies. It's not sufficient just to have the insurance qualified people understanding about ethics and behavior, because often many of the decisions about pricing are being made by the IT people who will be programming all the data scientists. And so thinking about how you make sure that the kind of code of ethics, standards of behavior and regulatory compliance is also extended throughout the organization, not just with the actuaries and underwriters, but also with data scientists. And that's one of the reasons why the corporate chartered program that we had, that we have in the UK, where we award chartered status to major insurance firms, we're looking to have a strong code of ethics, not just in the traditional insurance role, but actually throughout the broader organization.
Thank you, Lawrence. I think I need to tie up your last comment as you're just winding up. That comment ties up with what Agnes Macharia is asking. I'm sure you can see the comment there. He's asking, Mr. Smith, very good presentation on issues facing CEOs. It is apparent professional expertise is not enough. There's need for insurance professionals to be well skilled technologically. How is UK handling this?
Yes. So, I mean, I'm not sure the UK is necessarily handling it as well as it could be. So, but certainly I'm happy to talk from a personal point of view about some of the things I'm seeing, actually not just in the insurance sector, but in other sectors. So one of the things you increasingly find is that when you look at companies' risk registers, many of the biggest risks in organizations relate to technology. And yet, if you look at the composition of the boards of many companies, then they don't have people on the boards that are literate in terms of technology and don't have a background in terms of technology. Oftentimes, you'll have board members who will be accountants or governance professionals or legal professionals, but not necessarily technology professionals, and therefore are unable really to understand the cyber risks that companies are facing, and indeed form a view on whether they're being effectively mitigated. And what I'm seeing increasingly in many sectors, in fact, you can see this in sectors, I was talking about a week ago to someone I know who's very senior in one of the UK's big commercial property firms, and their board has now got a reserved position for somebody with a technology background, so that they're able to chair a board subcommittee specifically on technology risk, and that individual is able to challenge the management team on the technology risks that are being faced.
Thank you, Lawrence. And I think,
yes,
I think the next comment is just from a CEO of IIK, but I think it's just a comment from your presentation. I think she's indicating from your presentation, I think Kenya, we need to involve our customers more, look for opportunity to hear their testimonials. As Smith has said, we are far from this area. While we know without customers, we are not in business.
Yes, yep.
I think just the other comment from our director at IRA, Joyce Mishena. The insurance industry in Kenya is more sales-centric than customer-centric. I don't know who can give a comment on this. Is this Richard or?
Do you want me to?
In-house or
yes,
marketing?
Yes,
I can comment.
Yes.
Comparable to other financial services like banks, what we gathered from our research, that banks are very well aware of their consumers. They have their profile, they know their spending, and saving patterns. They pick up their needs on a regular basis, almost every day. They pick up information about the customer, and they know about a lot of patterns that the customer is involved in the way they put their money in the bank and the way they spend it. So how can insurance companies learn from this so that you continue, serving the customer during the customer's lifetime, and you grow your business around that customer? So yes, we need to be customer-centric and not just be interested in selling insurance. That's a quick comment on that part.
Yes, and I think from my point of view, and I mentioned this a couple of times in my remarks, it's always useful kind of coming back to not just even broader than serving customers, but actually the role of insurance in helping society to function effectively. So I'm involved in a group at the CI which also looks, participates with other representatives from other professions. And one of the things that we've been looking at over the last few months is how the different professions have responded to the COVID pandemic. And actually what a number of professions have done, and I'll talk about the civil engineers and also about the chemist profession, they've actually taken this as an opportunity to show how their professionals can actually help society to solve big problems. So, and the profession has actually taken the lead on that. So the institution in the UK of civil engineers, for example, there was suddenly an enormous need because of the pandemic for extra hospital capacity, and also to look at things like ambulances and how you reconfigure and redesign ambulances so that they are suitable to carry people with them who may be suffering from COVID. And so what the profession did there is it actually mobilized and created a forum for all of its top engineers to come together to say, engineers are problem solvers. Here is a sudden unexpected problem that society has got. How can we help to sort that out? The Royal Society of Chemistry is doing a very similar thing where it's got chemists, as the professional body for chemists. It has over 100,000 chemists around the world. It is providing the opportunity for them to collaborate on vaccine development and also sharing with one another the laboratory experiments, results, laboratory capacity when it's needed to do work. So this is all just a small example of how something that is a very high profile, a big concern for a lot of people, and the profession can show that we're actually thinking in a broader sense about how the profession that we represent is benefiting our workforce, but also other stakeholders, our customers, and also the development and good functioning of society more broadly.
Thank you, Lawrence. I think I will let any of the delegates or the presenters to touch on one of the comments from our delegates, and that is on one of the delegates is asking us to expound on insurance education and awareness to insurance of tomorrow, and basically focusing on the youths and graduates. I don't know, any of the presenters could take on that comment.
I'm happy to say a couple of words on that if you like, and again, an experience.
Please go ahead.
So what we've found in the UK is that there's a big misconception amongst people at schools and in colleges and universities about careers in insurance. Often it ranks very far down the list of attractive careers for them. And actually that is also attested in the UK. There are very few insurance chief executives who wanted to be insurance, have a career in insurance from when they were 5 years old. Oftentimes they just fell into it, sometimes as a second or a third career after they'd tried something else. And so what we've been doing, but actually on the other side, what we found is when people do come into insurance, they really like it as a career because it, first of all, it provides many varied career opportunities. If you want to work for a big firm or a small firm, if you want to have a job where you're dealing with people all the time, or you want to have a back office job where you're kind of dealing with computer algorithms, the diversity of jobs and career opportunities are quite stark. And so over the last number of years, we've been doing a huge effort as the CII in facilitating, reaching out to schools and colleges to talk to people about careers in insurance. Oftentimes we've not used the word insurance. We've used terminology about discovering risk, which we've found oftentimes with that will connect better or certainly stimulate greater interest amongst teenagers who will say, oh, that's fascinating, tell me more, because oftentimes their experience of insurance, maybe the only insurance they've ever had, might have been kind of if they've got an insurance policy for their first car, and that, or just watching or just seeing adverts for insurance on social media or elsewhere, which will all just be about price. So oftentimes they've got a very low image of the sector, which needs to be challenged. And again, doing that by, oftentimes when we go in and we facilitate going into schools and colleges, we'll do that with people who are maybe 5 years in their career in insurance, who can talk about what it's meant to them. And that really, we found that really helps to create greater interest amongst graduates. Oftentimes we'll also say to graduates, don't necessarily come to insurance as your first choice. If you want to try doing something else, you want to try a career as a musician, then go and try that, but have us at the back of your mind if you find that that's not what you wanted, then in a year or two's further down the line, look to come as insurance as a second career.
Thank you, Lawrence.
If I could add, Robert.
Just Richard, as I think I want you to tie up with a final comment there on what will you consider to be the roadblocks to insurance penetration and growth? And how will you attempt to resolve this? This claim is coming from Douglas. I think it's just one name.
Okay.
So
for the first one, with regard to investing in the insurance, both the career professional as well as the consumer of tomorrow, we also need to learn from their competitors in the insurance, in the financial services industry. A case in point is a bank that invests in both formal education and training, but as well as engaging with the youth and the consumers of tomorrow. Indeed, consumers of today, not even of tomorrow. So now, with regard to that last question, I think a number of points have been raised up, and I can pick one. The first one is on the customer still. This customer is seeking to be noticed. And most of the customers we have, maybe they're just data, just information there. How well do we engage with the consumer that makes sense in your top and bottom line? We need to know them personally. We need to engage with them. And we need to serve them right. We need to give them quality service. Now, that is a whole subject area, and we need to discuss, work around the customer. If you're producing a product, it should not just make value for you, the underwriter. It should make value for the customer for the long term. So these are conversations we need to have. So I just picked one on the customer. I'm sure there are many others that we can talk about that can help us to grow and retain the customer. Thank you.
Thank you, Richard. I think we are now ready to, thank you, Richard. We are now ready to proceed to the next presentation. I request delegates indulgence that we do the just next 20 minutes so that we don't have a break. And our request is our next presenter ready? We could actually start it off before we do a final overview of the entire workshop.
Richard Kloba, this is George. I wanted to make a comment. Would you allow me, or our time cannot allow me?
Quickly, if you can do a second as Alex just logs in. Yeah. Alex, okay. Are you ready?
The comment I wanted to make, Richard Kloba, is on what you are talking about the customer. And there are two things that underpin what you're talking about the customer. The first one is the emerging markets, the data that we've seen, and data management that is coming from there.
Thank you for that.
Because of that 56% of the market is there, Yet we are out here struggling with the 14% of the market. And if we go back to data and look at the census that was done, I think 2-3 years ago locally, you saw that 60% of our population is above 35%. That is one big component of the emerging markets. And now coming to the customer is for us to understand what that section of the emerging market is, what are their needs, and what do we need to do to serve them better. Before we jump to say we serve them better, do we identify them? Do we know them? Do we know where they are? Do we know their needs and how we can deliver them, their needs to them? And that, as Richard Oyara has said, is a big discussion, which, as we said, can be grown and developed by more research and benchmarking.
Thank you, George. Thank you, George. I think at this point I want to invite.
Before that, moderator, please allow me to ask the Secretariat to share the screen for KPMG, for Alex Mbai. I think they had already sent their presentation so that they can share so that he's able to continue. Thank you.
Okay. Good morning, everyone.
Good morning, Alex.
Yeah, morning, George. How are you?
Fine, fine. Good to see you.
Hi, Agnes.
Hi, Alex. Welcome. Thank you.
Thank you very much. Okay, I will start. Hi, Isaac. I can see you. How are you, Isaac?
I'm fine, Alex.
Good to
nice
see you.
To see you this morning.
Okay, thank you. Okay, so I will start.
Alex, you can't see your full face. You can tilt your camera.
Oh, sorry. Is that better now?
Thank you. Slightly better, yeah.
Okay, thank you. All right, so I'll start with my introductions for everyone. My name is Alex Mbai. I am a partner at KPMG East Africa. And I might be joined, I don't know if one of my colleagues who helped me work through this, Nikhil, who is our head of actuarial practice here in East Africa. He might be joining me at some point. Yeah, so I would like to thank the Institute for this opportunity, and also the Secretariat and the organizers for the interactions we have had come up with this. So I've been given about 15 or so minutes, and I would like just to stick to that. I have only about 7 to 8 slides, which summarizes my presentation. And therefore, I'll work with the Secretariat to just go through the slides. So we were asked to talk about the Kenyan insurance market gaps and the building blocks to local solutions. And this is a topic that is very pertinent, I'd like to say, because when we look at insurance, it's not just in Kenya, but in the region, in Africa, in the globe, we are seeing this becoming a very fast-moving space. So there's a lot that you see us talking about in around digitization of the sector. I think, as you know, that this is one of the sectors where we have been using quite old technologies, but now this is the time. And when COVID came, I think it was an accelerator into the digitization with this environment of remote working from home. So insurance as a sector cannot afford to continue to lag behind the other sectors. So we'll talk about briefly about digitization. The other block is around operational excellence. Again, how effective is the sector managing its financials, operating expenditures versus the premiums it gets, investment income, and all that, so that the insurer, and I just listened in the last bit, at the end of the day, is there anything to be, some value to be added to the insurer, to the shareholder, to the customer, to the policyholder. All the stakeholders are looking at this this operational excellence so that they are left with something of value at the end of the day. The sector is faced with a lot of regulations. We have, I believe we have the regulator in the room, and every now and then we are seeing a new regulation or an enhancement to an existing regulation. And of course, this is causing insurers to be on their toes around risk management, capital management, and many other areas of their businesses. So regulation is a key item that we are seeing globally that is regulating this sector. I touched briefly on COVID-19. It's the new challenge. I think right from March, no one knew where all this was headed, where it would be by now. And I think even if perhaps the curves will be flattened, I think there's a clear indication that this is here to remain, and therefore the new norm or the new normal will not be as it was before. So what is it for the insurers to do? And then we'll put all that together in terms of the next solutions and way forward for the sector. If you can go to the next slide, please. So this is where we then talk about, just a second, I just want to move. Yeah, that's, wanted to see, yeah, I can see full screen now. Can I just get back? It doesn't look like I'm able to see the full screen.
I think we request Secretariat to put the presentation to full screen slideshow.
Please.
Yeah.
Okay.
So
I'll talk, yeah, that's okay. I'll talk about digitization. So I think this is where we are seeing, and what you see on this continuum, you're seeing three key things. There's the government involvement, there's emerging markets or new markets, there is technology. And these insights you're seeing here are global. And you'll see where, as Kenya, where we are. I think perhaps we have, out of this, about 10 items, 10 or so items surrounding digitization. I think in Kenya, I would say we are in 4 out of 10, because we are not yet at blockchains. I think you hear in technology, blockchain is a new currency, and that is beginning to take effect in other markets. The Internet of Things, everything being done through internet. And I'll talk about this because what you see in other jurisdictions, the insurance sector has gone into internet to underwrite an insurance cover end to end through use of technology. So there's no longer those manual policyholder forms, which are a very small print, which have quite old techniques of doing things. Now insurers globally are able to underwrite insurance end to end and also process claims through use of technology. So that's something that we'll be looking to see in this market. And I'm aware there are some insurers in this market who have already started doing some of these things. I've seen, for example, an insurer who is using car insurance and working closely with the customer. They can monitor the movements of the customer, such that when a customer comes in and they are given an insurance cover on their car, the insurer is able to remotely monitor how they are driving, which traffic lights they have crossed, how many accidents, are they able to observe the black spots? And if there's no incident of claim or the incidents of claims are minimized during the year, actually the insurer is able to work with the customer to return some of the premiums that they paid. And I think this is clearly one of the auto insurance that we are starting to see. And I believe that we will see more of that. We have some bit of agricultural insurance. Crop insurance, I think, is still quite a new concept, but I think farmers are looking for more around insurance of their crops because of climatic changes. This is an area that insurers would need to go into, because someone would like to be compensated for loss of their crop, whether through floods or droughts because of the fluctuating climatic conditions. Drone insurance is no longer here, or use of drones to monitor incidents of claims is something that we hope our market will be going into. So it's a gap that we hope it will be closed in due course. I'll just pick some other bits of innovation. You know, InsurTech and FinTech are quite new areas that we are seeing in the global market, and which we hope in our market here will be adopted. I'll touch briefly on regulation, and I touched about this earlier, where the regulator has changed the ways of measuring capital and solvency from what we used to see before. If you remember the old section 41 of the Insurance Act, now we have moved towards RBC, the risk-based capital, and the regulation here, in fact, we should have adopted the 200% the capital adequacy ratio by end of June. But I think because of COVID, the regulator was kind enough to give some exemptions and move the deadline to end of this year. I think we saw some Gazette notice around that recently. Therefore, it's a new way of looking at capital and solvency that has changed from the past. The channels of distribution still need to be looked at, whether we continue to use brokers and agents, and you know this is quite an area, because that is linked to the cash and carry rules. I think we have been told in the past, when cash is received from the policyholders, you know, the brokers and agents have the appetite to keep that money and only remitting that to the insurer maybe when an incident happens. So that perhaps does not fully comply with the cash and carry rules that we have, not only in Kenya, but also in the East Africa region. I think it has worked very well in Uganda and Tanzania. Insurers are also being checked on expenditure, because there is permitted expenditure by the regulator. And a lot of times you find that this being, the budgets or the limits being burst, which then does not quite please the regulator. And we have seen the regulator issuing circulars and saying any excess expenditures, any excess commissions are not really permitted by the regulator. With all this, you know, we have a new standard that is coming into effect. It has been coming and going in the last 2 years. We were to have it implemented by 1st of January 2021, but the International Accounting Standards Board has moved that to 1st January 2023. That is the new accounting standard globally to be used by all insurers for accounting. And therefore, I think we look forward to that standard. And I think a number of regulators and insurers have already started thinking about that in this region. Off to the next slide, please. Thank you. So what we have done here is to visualize so far what data are we seeing across the insurance sector here in Kenya. And I'll not go to a lot of details, but we've just looked at certain parameters and just observed how the landscape has been changing for the last 6 years or 7 years. So you can see the gross premiums, how the trends have been, how the insurance penetration ratios have been. And in this sector, what is the ratio between general business to life business? And you can see clearly on the last chart there, the circular chart, life business is still at 20% of the entire sector. And therefore, that links to how low the penetration rate of insurance is. And I think the regulator estimates that to be between 2 and 3% of the GDP. So you can imagine that we still have Kenya is one of the underinsured, especially around the life business. countries compared to other countries like Nigeria, South Africa, and outside of Africa. So there's still a way to go in terms of the take-up of the insurance product in this market. Next slide, please. Next slide, please. Yeah, so now here we talk about the operational excellence, and this just briefly to highlight some of the challenges that we are seeing in this area. And as I said, operational excellence is how you measure the entire value add in an insurance chain. When a policyholder brings 100 shillings, for example, for premiums, how much of that is spent in generating that income through paying the broker, the agent, the commission? How much goes to pay salaries of staff and other people involved in the business? How much of that goes to pay tax? And how much of that then at the end of the day is left to go back to the investor? For that to happen, there needs to be some investments, and this is around the systems that's around that that insurance cycle. What we are seeing is that there are challenges in operating models and process designs to just administer that process I've just talked about. Insurers are still using quite old legacy systems. They have not invested in new systems, new IT systems and methodologies that are going to really monitor that operational excellence. And this will be tested when IFRS 17 comes into place, because accounting properly for the insurance value will need a proper investment in a system that can give you all the information and data that you need for that monitoring. Distribution channels, I talked about use of brokers and agents, and if that will still continue to happen in the new normal. Alternative sourcing, so if you cannot do it internally, you have to look outside. To what extent will insurers need to do that? And intelligent automation, the Internet of Things that I talked about. To what extent is this market embracing that? So there are still some gaps around operational excellence that we continue to see. Off to the next slide, please. Thank you. So again, now we talk about the entire enterprise risk management. Are you strategic? Are you integrated, or both? And we have done some surveys in the past where 80% of respondents are telling us they discuss risk at least quarterly with their senior executives. Yeah, but they are mainly retrospective as opposed to dynamic and forward-looking. So when you sit in boardrooms, when you sit in those senior management meetings, are you discussing risks in your business? Are you embracing, as insurers, the new methodologies, the new technologies in your strategy? And what we are hearing here is that when we look at across the sector, not many people are forward-looking. Yeah, 50% felt that their enterprise risk management program is integrated well with other assurance functions and the company as a whole. So only 50%. What about the remaining 50%? What are they doing? So how do you integrate all this with your governance, risk, and compliance? Yeah, and therefore the full enterprise risk management is not embraced as yet, and therefore there's just a gap there in terms of trying to embrace everything within your strategy, your entire chain of governance, risk, and compliance, and how then you generate value out of that, having the right investment in people, in systems, in resources, and everything that you need to do. All that needs to be proactively managed, the embracing of change as it comes in, and linking that to your entire strategy. Okay, I'll go to the next slide, please. So when we talk about then the COVID-19 impact and the new normal that COVID-19 brings in, it directly impacts ERM that we've just talked about. It directly impacts your capital. And as I said earlier, the capital now is based on the risk-based capital formula that has been given by the regulator. And there was a requirement to comply by end of June this year, which did not happen. So COVID has made some focus of that to be moved to one side of the year. But to what extent will insurers meet the 200% capital adequacy ratio? It's not an easy thing to do. And I know insurers have been monitoring that. Some are, the majority, I think, are between 100 and 200% ratio, but there's still really a long way to go, because people have to look at their solvency monitoring processes. Yeah, look at how they're executing on the written employment, insurance and employment contracts, what they're paying in claims, the expenses they're paying for their employees, and to what extent then do they still remain solvent. So points for consideration will be around continuous transparency on current capital and risk positions, flexible scenarios because of the COVID-19. And you remember when COVID came in, the regulator required scenario analysis and stress testing by insurers, and actually to file those stress test results with the regulator on a regular basis. Yeah, application of expert judgments. Yeah, because this situation of COVID is unclear how long it will be here with us and how far it will go. So success will be for the insurers who continuously monitor this, the impacts, and formulate policies that counter the effects of the pandemic. And for you to remain really on the cutting edge, you must do this earlier and better than others, so that then you remain profitable and surviving in the industry. Next slide, please. Yeah, so this is sort of the last slide. And here we talk about then just further depth around the COVID-19 impacts. I think you're already aware that we have seen remote working environments much more than ever before. So connectivity, collaboration tools. The question is, for example, as insurers, what are you doing to check what the systems are doing behind the scenes? You are not connected to the system every time. You're not in the office to check what people are doing. What is happening behind the scenes? So cyber risks, risks of fraud. Are you paying the right claims? How have you verified those claims? To confirm that you are paying the right claims is a question that continues to be important, because you're having virtual meetings, you're having cloud-based storage and operations. The question is, and I think as the auditors would ask, is the right thing happening? To what extent has everything been verified, so that then you're sure as insurer you're paying the right costs? Digitized systems, there's no going back now. Having moved platforms into this new environment, there's no going back, so that will continue to be monitored. Capacity, we have talked about. Are you able to handle the requirements of the new situation? Platforms becoming more and more mainstream. Regulations, we talked about that. Offshoring, I think different insurers, especially the global ones, will be moving to more diversification, perhaps opening businesses in other markets more than ever before. So planning is a lot more complex under the current situation, and exposures need to be reimagined. You know, people were talking about perhaps a second wave, which I think perhaps has been seen, for example, in Europe. And the question is, what will get here and what will happen? The old broker agent distribution models, will those continue to happen? And how possible are those digitally and virtually? and the overall thing of business continuity and resiliency during this time. That's what we tied to the operational resilience and excellence. Is there any remaining slide?
I need you to conclude.
Yeah. Thank you so much. The rest is really just our contacts in case you like to engage us further on this topic. But I'd like to just sum up and say, as a sector, we are in a new space that is really unprecedented, and the sector cannot afford to go back to the old ways of operation. We just need to embrace technology and run with it from here under the new normal going forward. Thank you very much. That's me, Alex. I'll pause.
Thank you, Alex.
Yeah.
Sorry?
I'll just say now, I'm able to take any questions or comments before we close my session.
Yeah, there's an immediate comment there from Agnes Macharia.
Okay.
You're able to see it? I can just read it for you. With so much online money dealings, sorry, I need to read the earlier one from Jack Kionga. Jack says industry partnership models with government digital solutions like eCitizen, IPRS, Teams, Huduma number will become game changers for market penetration, fraud mitigation, data analytics, and operational efficiency. Just to need to pick your quick thoughts on that.
Yeah. That comment ties in very closely to new ways of doing things. So, because insurers will not get customers walking in like before, walking in and starting to ask for forms to complete to buy insurance. I think insurers will have to check, how do they reach out to their customer? How do they serve the customer? Because the whole thing is just really around the customer service and where they get those customers. So getting this through eCitizen, partnerships with the public participants and all that is a new way. And when the customer has been allowed in, the security checks, the background checks, and whatever must be done will have to still be done digitally. So there's no ways of asking for references and asking for, do you know this person, do you know this customer? That perhaps will not continue to happen in the current situation. And therefore, I agree, that is really a real game changer. I think there was a question from, you said Agnes Macharia.
Yes, you can take up the next one.
Yeah.
Take up the one from Agnes, which is, I think it's a comment, but she also wants to get your experience. With so much online money dealings, risks are increased. How are financial institutions coping, and how safe are we as we get statements online? Are we ready from your experience? We just need to pick your thoughts on that.
So the first thing I'd like to say, and I think you have said this before, in the new era of cybercrime, there are two types of organizations. Ones that have been hacked and those that are yet to be hacked. It's the unfortunate message here. And someone said that there's a third category of ones that have been hacked, but they don't know that they've been hacked. Yeah. And this is not uncommon in this sector. I think a year or so, you heard of an insurance chain that was actually hacked, and they released some of those messages to the public. So because of online transactions, online money, the strength of the institutions is really as good as their own IT systems. And to what extent have those been checked and verified and rechecked that they cannot be hacked, or the right thing is happening? And this ties to what I said. Because of the environment of now working remotely, you're not there to check who has approved what, the electronic approvals, yeah, the release of the statements, who has checked that, then there's a risk right there. And therefore, you will perhaps need, as insurers, to involve a lot of IT experts, your own advisors, and also check them and ensure that they check for you that the right thing is happened. So the risk has moved from supporting the manual documents of supporting a transaction, supporting a payment, a receipt, to actually supporting it online. And therefore, IT auditors and experts are required more than ever before. So the risk, yes, is very much there and needs immediate action.
Thank you, Alex. And I think any comment from any of the delegates in attendance? We are just coming to the tail end of our workshop before we start the wrap-up process. Any other comment you can? I'm not seeing anybody requesting to talk, but you can unmute your mic and give us your comment.
Okay, Richard, I can make a comment. This is George. Just to emphasize on what Alex has said, it is the participants should not get that we are saying there is no technology, but actually optimizing the use of technology in operational efficiency and distribution and connecting with the clients. Because from the research that we have done recently, it shows that the digital platforms were the most efficient in connectivity with the clients, but the least used. Incidentally, now with the COVID era, everybody has gone there and we've seen the efficacy of them. And if we look around, we'll see there's a plethora of them. As he has mentioned, the partnerships with eCitizen, there is GIS technology locally available here, which connects the clients and the customers, and which can enhance the risk-based assessment processes, the pricing, collection of customer data, aligning it with our corporate strategy. So it is optimizing the digital platforms, doing a bit of research, benchmarking, and seeing how we can optimize on them, because yes, they are there and they will help us in the long run, in the short run, and in the long run.
Thank you, George.
Thank you, George. Any other comments? I've seen on the chat, I think exhausted.
Richard, I've been joined by
yes,
my colleague, Nikhil. I don't know, Nikhil, if you have anything to just comment or add on the presentation.
Hi, Alex, and morning all. Thank you. No, nothing much to add. I think you covered everything. Yeah, I think maybe from the digitization that we've seen, which I think you've already covered, it's just the Internet of Things and how we're seeing companies now adopt technology quite heavily. I think like how we've said, how Heritage launched its telematic insurance solution last year. We've even seen some insurtechs come up like Griffin Insurance, which are looking to provide a digital car insurance directly through an app and trying to get rid of the whole paper-based system.
Okay.
Thank you, Nikhil. Okay, I think before I give the closing remarks, Richard, just a minute.
Okay.
Before I give the closing remarks, I would like to request the presenters if you could just a minute each, just to give your closing remarks, having listened to the comments from delegates and the other presenters. I want to start with IIP. Richard, I know you are ready to go.
Thanks, Robert and IIK for this program. In one of our slides, Isaac did mention that we need to have a robust dialogue. And my recommendation is that we need to have more of this kind of discussion and more of these workshops. And we probably even have to look at areas where we can follow through on implementation, both at industry level, but at company level. And lastly, with regard to that comment on technology and helping us to manage money laundering, insurance companies like to take risks. Yeah? We should not run away from risk. And chances are that there are companies already giving protection on money laundering. When you're interested in insuring a risk, you should also be interested in mitigating against that risk. So I would like to challenge us to look at ways in which we can understand this risk, we can insure it, and we can be safe so that it does not become a loss maker. Thank you very much, everybody, for being here.
Thank you, Richard. Isaac?
Thank you very much, Mr. Chairman. One of the issues I would like to just add, in addition to what we said, is one basic area which touches on our finances that I think also Alex can comment on that later. This is on the issue of pricing the risks that we undertake. That is the basic professional issue of pricing of our risks and the methods that we use. And I just said that there is very limited risk assessment. That means that we don't even do any risk modeling, which is not there, in order to determine the risk-based prices for the risks that we undertake. And this is one of the issues that, of course, affect the revenue account, our balance sheet, and affect everything else because that's the start of anything. And it's a pity when you look at what happens in the market because of these unhealthy competitive practices. You find that we tend to amplify risk-taking like in motor, but our premiums keep going down. We reduce market discipline, which is there. We create competitive distortions, and you find that this can increase the possibility of distress in the future. In fact, it has been doing that for many companies, and that is the scenario that we are talking about here, about the stress scenario analysis that was required because of COVID-19. It's actually required for everything that we do in terms of pricing. And in view of the RBC regime, it will be necessary for us to look at that one very critically and look at it because many companies don't even bother looking at even the burning cost ratio of the risk we underwrite. I think that is one of the major failings of our underwriters, because what we are really doing is that when you hear of cash flow underwriting and things of that nature, we have more or less attenuated, filmed out the basic commodity process of insurance. That is underwriting, taking on risk. And when we have reduced that business, we are left with only an administrative process, in which case our business is redefined simply because we are not undertaking risk modeling, we are not charging premiums according to the risk. And this is the issue. So we are changing.
Isaac?
Yes.
Isaac, if you can hear me, thank you. I think we need to move to the next.
Okay.
George?
Oh, thank you, Robert. You already graciously gave me a comment earlier and I commented, so I don't wish to take much of your time. Thank you.
I will move, Lawrence.
Okay, well, thank you very much. I'll be very brief with my last message. It's just to say thank you so much for inviting me. Thank you very much to the IIK for organising it. Thank you for your excellent chairmanship. I was just going to say one reflection really on competition. Obviously on this call we have chief executives from many companies and you're in competition with each other. And I think there are many areas in which it's quite right that you compete with one another. You want to compete with one another to be the best at underwriting risk, to compete with one another to be attracting the best staff, compete with one another to be the best at technology innovation, compete with one another for the greatest market share, and compete with one another to give the greatest profit for shareholders. But I think one of the areas where you do not compete with each other is the issue of standards and professionalism. And this is definitely an experience that we've had in the UK. That's an area where I think you should be collaborating because you're all partners in that. If there's one company that has poor standards, that's going to be bad for everybody because it just undermines trust in the whole sector. And the only result of that is that people go without insurance and therefore they end up having catastrophes that they're not insured for. So I think a commitment amongst developing within the industry that when it comes to standards and professionalism, you will all uphold and strive for a comparable kind of basic level, a shared level of professionalism, I think will do a lot of good to help build the reputation of the sector, and therefore the penetration that you spoke about at the early on, and also the size of the pie which you spoke about early on. Thank you very much once again for everyone at the IHK. I've really enjoyed the discussion, and I think it's been a very fruitful event.
Thank you. Thank you, Lawrence. Alex, if you are there, you could give your closing remarks.
Thank you, Richard. I think perhaps nothing much more to add. I think just to re-emphasize the bit of operational excellence during this time, and how insurers need to look at their value chains, right, from pricing of their products all the way to when they settle the claims and when they collect the cash. And just to re-emphasize that nowadays, any outstanding premiums are generating big capital charge because the regulator is not allowing any insurance debts to be carried forward. So it's a new area of thinking for insurers and brokers as well. Thank you very much, Richard.
Thank you, Alex. And maybe just a comment for you, Alex. The regulator is in the house, and you might need to engage him outside this forum for some information from your presentation that you might need to correct.
Oh, okay.
But that is outside the presentation. Yeah.
That's fine. We'll engage.
I just want to close with a few remarks, but I don't know whether my colleagues want to say something. There's a comment from Agnes Macharia on addressed to the IRA, and I wish to request my colleague to take it up. Kalai.
Okay, thank you, Robert. I need to comment on the comment by Director Agnes on the issue of cash and carry and how it's working in the other countries. It's actually not just in Uganda. I think Tanzania is also working. And we have information. We talked to the regulator that it's working very well. What have they done? It was simply an issue of changing the legal framework. They changed their laws to allow directed payment to insurers, and that has been implemented. As you are aware, in our case, we proposed amendments to the law, but I'm sure you are aware that there is a court case on that issue, which we are waiting for. And hopefully, if that goes through, then we'll be able to implement. On the issue of flexible payments, the law actually does not prohibit, or there's nothing in law which says premiums cannot be paid in installments. And I think in his opening speech, the commissioner mentioned something similar to that. So it's just an issue of companies designing their products to be able to take care of the issue of flex payments. Because like what the commissioner say, are we on credit and business? Why are we charging our clients for IPFs or things like that? Why not just design some flexible products where the premiums can be paid in installments? So it's something which can be done, and we agree for the SMEs. So some of them may not be able to afford that premium instantly. So it's something we can think as players and come up with appropriate products. Thank you.
Thank you, Kalai. I want to summarize just on the presentations that we've had since morning. We've had 5 presentations. The first presentation was from the commissioner on the invitation of the director, Agnes. And the second presentation was from the IEB team that we had George, we had Isaac, and we had Richard, and quite a number of issues were raised. We also had 2 presentations from Lawrence from CII London. And finally, we've had a presentation from Alex, and that crowns our engagement this morning. Through those 5 presentations, we've had quite a number of issues being raised, and we've also had delegates raising issues through the chat, which we've been able to handle, by the team has been able to handle quite well. And not in any particular order, but I want to highly summarize what are some of the emerging issues that we are being challenged as delegates, and especially the CEOs in the room as we get back to our workstations. Some of the things just we need to think about. One thing that has come up, and I think throughout all the presentations from the commissioner's speech, all the way, is the issue of data. As an industry, we have quite a lot of data that we are sitting on. How do we leverage on this data to address some of the challenges that the commissioner raised in his remarks in terms of product development, customer service, claims management, and looping this into with technology to see how we can be able to improve overall service delivery to our customers. I think a key issue that came up from even the opening remarks by Director, IIK, Commissioner himself, and the CIA presentation is the issue of professional development. And we are being challenged to see how we are going to upscale our professional standards as players within the sector and be able to operate with ethics. And I think it behoves upon IIK to see how they can put all of us together to be able to address the issue of professional standards within the industry. And I think as we get out of this room, CEOs, we need to be thinking of what is the way forward on this. Then there was the issue that was raised by Lawrence, and I think all the other speakers. It still touches on professional knowledge and behavior, and how we look at the whole entire ecosystem of how we are managing partnerships to be able to handle the issue of professionalism within the sector. Then the issue of treating customers fairly by understanding their needs. And I think the customer is seeking to be understood. And I think it behoves upon all the delegates in this room to see how we're going to focus on the customer and ensure that the needs of the customer are taken care of. Then still on staff, I think going forward, there was an issue that was raised by Lawrence, which, just to paraphrase him, that top on the CEO's agenda should be focusing on staff capability. And how are we going to upgrade the knowledge, skills in order to navigate through the new dispensation. Also, a challenge that has been posed to us is as CEOs embracing a culture of openness to ensure that we are able to blend success and navigate through the turbulent times that we're going through. Then I think the final bit which was raised, and I think it was just a request from Richard, is and then where do we go next? See how we can replicate a forum like this quite often, so that we, as a sector, we can be able to put our heads together to discuss issues that are affecting our industry. Then finally, I think for this, just for myself, I have about 4 issues that I think just to help challenge ourselves. And this is based on the discussions that we've had throughout the presentations. Then just one question. These are 4 questions that I have. One is, as an industry, how do we define success? If you are a CEO, you are a chief officer somewhere, what is changing and what do we expect to change, especially in the new normal? How do we ensure we are playing the lead role in whatever that we are doing? And then finally is, as a CEO, after we sign out of this conference, this workshop, what's your checklist as you enter into the new normal, given what is happening around us in the entire sector? And I just leave you with a quote. I think it's an anonymous quote, which says, the cost of inaction is much greater than the cost of action. And I leave that challenge to the CEOs in the room and all the delegates as we close out on this forum. So on that note, members, I think we've come to the end. I want to take back to Christine to give closing remarks and
Thank you so much, Mr. Kuloba. I think a lot has been said. For me, it is just to thank the team for having graced this workshop. We are very thankful to IRA. Thank you, Commissioner, for gracing this event. Thank you, Board of IRA. I'd like to thank my colleagues at the Institute, the entire Executive Council. Thank you, Director and Deputy Director IIK. Thank you so much to the presenters who have given us a very informative and very exhilarating session, quite thought-provoking. So we are leaving this place with quite a bit to think and basically ponder over so that then we can implement quite a number of these things. I would also want to thank the delegates. Thank you for creating time in your very busy schedules. Your CEOs, we have GMs, we have COOs, and various stakeholders. Thank you so much. IIK is grateful for that. With that, I would like us to bow our heads in prayer and just close by thanking the Almighty for having taken care of us. Almighty God, we thank you. We honor you for this time. Thank you for having taken us through this workshop successfully. We commit this industry into your holy hands because we know we cannot do it on our own. We are cognizant of the fact that you created all, and all knowledge, understanding is yours, and that is what we ask for, so that we are able to move this industry to the next level. Indeed, we want to ensure that the pie is bigger for all of us to share, and we are asking that we do it in the right way. Guide us in all that we do. As we go back to our workstations, our prayer is that you will dismiss us with a blessing, and all this we pray in Jesus' name. Thank you so much, and God bless all of you.
Amen.
Amen.
Thank you too, and have a good day, all of you.
Thank you.
Thank you.
Thank you so much.
Thank you. Goodbye.
Okay, bye.
Amen.
I like that. Thank you.
Thank you.
Bye.
Richard, this is the goodbye, please. Just wondering.